Yo, what's up, guys? We are going to be going over 10 stocks that I think you should buy next week. Today's currently Saturday, and I want to show you their actual fundamentals. We're going to be deep diving into the numbers. I'm not going to be like, I don't know what I'm trying to say here. We're just going to be deep diving into the fundamentals so you can draw your own conclusion. I'm not trying to convince you of anything. I just want to show you some stocks that I find very impressive. Some of these stocks I do own, some of these stocks I don't own. But yeah, without further ado, let's just get straight into the video. So the first stock I actually think is a pretty fair buy is actually Robinhood, the actual app I use right here. It's called Robinhood. I'm a user and I love what they're doing with the app currently. Like they're really pushing these prediction markets right now, which every time you buy a stock or sell a stock, they keep like a 0.1% fee. But whenever you do a prediction market contract, they keep a 2% fee. So it's literally 20x more valuable for their bottom line. And let me show you why. I think they're going to be a great buy and hold stock for the long run. We actually get this data, their event contracts traded. They created their prediction markets in 9/20/25, and it did 1.7 billion traded events. And just this month in January, they did 3.4 billion events contract traded. Now, one of the reasons why they did fall on earnings is because the crypto revenue did fall a little bit, or it missed expectations by like 22% or something. I think it slightly fell. But anyway, I'm just very bullish on the prediction market and just the overall fundamentals. Like they had the highest net margin they've ever had. If we scroll out on their revenue right here, this is what you want to see for a growth stock. Are going to buy and never sell. They did 1.28 billion in revenue, and on this 1.28 billion in revenue, they netted after tax 605 million. And that quarter where it says it's down 33% year over year, it's not actually because they had a one-time adjustment this quarter. And this is really the after-tax number, 605 million. That's after they paid 45 million to taxes. So that means their real net margin is the highest ever, a 47% net margin. It's just incredible. So these brokerages have just incredible margins. That's why I own a little bit of Webull, Robinhood, and Moomoo stock. So let me know what you think about them. And I don't think the forward PE is nuts. Let me actually check that real quick. Yeah, the 31 forward PE, I think that's very deserving for a stock like this. They're like the picks and shovels play of fintech, where they just collect a fee every time someone does a crypto transaction or a prediction market. So it's almost like you get exposure to crypto as well. So the next stock I actually want to go over is Uber. So I really like their valuation. There is some increased competition right now from like robo-taxis and Waymo, they're saying. But let me show you their valuation and let me see if there's any news. Yeah, Uber introduces Uber Autonomous Solutions Platform for global robo-taxi development. So they're not going to be out-innovated. They're actually investing to get into robo-taxi deployment, which is pretty interesting. And check out the valuation. This is why I think Uber is super fair on the right. Uber trades at only 22 times forward PE, so only 22 times next year's net income. I think that's very fair. We can actually see their monthly active consumers. It's 202 million, when this exact same time last year was 171 million. So they really are growing their monthly active consumers, which is great news. Their main ride-sharing business, mobility, that is up 18% year over year. After grew 25, after grew 33. So they're just on a streak of growth, and not just the mobility revenue, but also the delivery side, which is Uber Eats and B2B, mailing and stuff like that. That's up 30%. Like the growth rate over here is growing. It's up 30%. After grew 21, after grew 7. So the growth rate is growing on Uber. It's insane. And again, we're looking at the forward PE metric because they had a total one-time adjustment last quarter. It says they made 6.65 billion of net income. They didn't actually. They only made 1.1 billion. But if we zoom out, Uber this quarter just had the most profitable quarter they've ever had, 1.77 billion before tax. And again, we're looking at the before tax because it excludes the one-time adjustments that they've been having. So really was the most profitable record quarter they've ever had. And same with free cash flow. They did nearly 3 billion of free cash flow and they don't pay a dividend and have much debt to pay. So they're just doing a ton of M&A, buying a bunch of companies. Like they just acquired Spot Hero. It's an app I use. And I just think it's genius. So I don't think they're going to get crazy out-innovated by robo-taxis. I do like Waymo. Hey, what's up, guys? What up, Shaked? And Cool Money says, should we short oil? Hey, that's an interesting thesis there. What's up, Nick? He says, I got destroyed yesterday. Dang. Robinhood CEO is on Bloomberg trying to pump the pre-IPO fund. Yeah, look at this. I don't know what it holds exactly, but yeah, here's the Robinhood Venture Fund. It opened and it was at 25 and now it's at 21. So it fell 16% the day it opened. But I am curious to see what that actually holds. I haven't done much research onto that. I also know Robinhood is getting into like credit cards and like partner banking. Let me see if there's any more news around Robinhood down here. Let's see. Yeah, 658 million venture capital fund for retail investors. Robinhood launches a $695 platinum credit card to compete in premium rewards markets. So it's actively coming for like American Express specifically. So this invite-only card offers 5% cash back on dining and flights, 10% on hotels, $300 in travel credits, 500 in hotel credits, 250 autonomous ride credits, and a priority pass air lounge for $700 a year. So I guess that's its main pitches there. So hey, that if you like to travel a lot, maybe that could be better than your actual card. Who knows? So yeah, I do really like Robinhood. They're just so innovative. Like they're getting new streams of revenue. Yo, what up, Caden and Plasma? Good to see y'all. Tuning in from Vermont ski lifts. Hey, very cool. That's awesome. All right. Oh yeah, actually, let me get back to my list here. I made a list of stocks that I think are 10 stocks I think are pretty interesting to buy next week. Now, this next one is actually a royalty company. You're not going to believe the margins on this company, and you've maybe or maybe not have heard of them. This is ARM. They're like a competitor to Nvidia. Like every Apple phone has a ARM chip in it. They make like these energy efficient chips. And right now, let me show you where the revenue comes from or how they break it down. Check this out. Or used to have it like by breakdown. So yeah, 60% of the revenue is their royalty revenue. And then the other 42% of the revenue is their licensing revenue. These are very high margin segments. So if we go to the gross margin, literally a 98 or 97% gross margin. I mean, they're just printing money. And here's their top line growth. This is what you want to see for a growth company. You know, the revenue is growing very nicely. And same with the net income. The past couple quarters, or let's see. Looks like it did fall 11% year over year. Okay, so the actual core business grew 9%, so they might have had a little one-time adjustment. But yeah, they're making a couple $100 million of net income a quarter. Expectations are good too, but it's still really expensive. That's the only thing keeping me from buying ARM. Like it sucks. I love the business model with this crazy margins, the royalty stream, but 107 forward PE. It's just a tough valuation to pay as much as I love them. And yeah, here's they're diversified internationally as well. So yeah, ARM's pretty cool. Is there any news around ARM right now? Let's check. Nah. Okay, next up I had on the list. Oh, this is a robotics play. I've looked at a lot of robotics stocks. Like I used to get this one all the time. Like Rich Tech Robotics. This is like one of the worst like robotic stocks that exist. But I'm going to show you my favorite robotic stock. Actually, my favorite robotic stock is Amazon, but this one would be like a close second because they're also a warehouse robotics company with real revenue, real customers. Their largest customer is Walmart, and I'm really bullish on warehouse robotics because it helps out the logistics. It's replacing humans, and Walmart loves this company so much because they're their largest customer. Walmart took a stake. Walmart owns 12% of all the shares, 12% of this entire company. And check out this revenue growth. This is the robotics company I want to own. They have over 1,500 registered patents. This is nuts. And the revenue's up 29% year over year, which is great. And they finally made net income. So, you know, this is just great news. They're on the tinker of profitability every quarter, barely losing any money, made money this quarter, really good free cash flow numbers. Walmart owns a big chunk of them, expecting more growth. Look at that. Revenue is supposed to go to $700 million in 2 quarters. And they're supposed to get profitable in the next 2 quarters. So I'm just very bullish on Symbiotic. I can actually pull up their website and show you kind of like a image of kind of what they do. Because it's actually very fascinating. I've looked at their investor presentation many times. Yeah. So I'm really bullish specifically on the warehouse robotics companies. There was, they have like a little video they used to show. Yeah, it's just kind of, anyway, it just helps out. Like Amazon's big in this industry too. But yeah, they just help out the logistics and replace humans. So that's one of my more favorite, like second favorite, like robotics play. Walmart's a big customer. Yo, what's up, James? And have fun respawning. What's up? He said FLS. Let's check this one out, actually. FLS stock. Flow Swerve. Yo, what's up, Cruz? Good to see you, homie. I noticed you're also looking at Path. Hey, I do own UiPath. Yeah, that's one of our worser holdings right here. Yeah, we're down 43% on them. Yeah, thoughts on Rich Tech Robotics? Yeah, Rich Tech Robotics is absolute trash. Buy a Symbiotic instead, because they're also on a dip. Okay, so here's a Flow Swerve right here. Let's see. So they're actually very cheap on a forward basis. Hold on, let's see here. So if you look on the left, it says they're a 28 PE, but on the right, they're only at an 18 forward PE. So literally a teen forward multiple. So what did they do? Flow Swerve pumps division. So it's kind of growing mid low single digits, 4%, 2%, 0.8. So we kind of want to see that grow a little faster. What about their flow control division? Yeah, it's also kind of the growth is kind of slowing down a little bit. So yeah, actually for the past 3 quarters in a row, kind of check that out. They've been missing on top line revenue expectations for the past 3 quarters in a row, but the stock has done phenomenal. Well, I mean, it's actually this stock is technically the same price that it was in 2014, but they're at an 18 forward PE. Let's see if they're making money. So historically, they are making money every quarter. They must have had a one-time adjustment this quarter. Let's see. Yeah, they did. So they had a one-time adjustment this quarter. Actually, this quarter was a great quarter, excluding that adjustment. Like the highest amount of money they've like made in the past couple years. Anyway, yeah, that's why. Yeah, so them losing net income this quarter, that's probably why the PE ratio is a 28 because it had negative EPS. Interesting. Well, we kind of just want to see the growth come back. Cause yeah, 3%, 3, 2, 5, 1. It's kind of low single digit growth. That might be what is keeping the stock from really growing a lot. What do you think of banks like JP Morgan? Yeah, these are great. Actually, I really like JP Morgan right here. I think the risk to reward is starting to look pretty decent. It's also a great dividend growth stock. We've all heard of JP Morgan before. And hey, Joaquin, yo, thanks so much for all those gifts there. We'll definitely check out Broadcom. Thanks so much. And Isaiah, no way, dude. Hope you're doing well. I appreciate you, man, for that gift there. Well, check out HIMS. I have not seen the HIMS news, actually. So here's JP Morgan. It's a great dividend growth stock. If you buy the stock right now, literally for the rest of the time, no matter what, you're getting over 2% of your money back just in a qualified dividend every year. And notice they raised their dividend very fast, way faster than inflation. So every year you're getting paid more and more and more. And they have a very low payout ratio, only a 28% payout ratio for a 2% dividend yield. That's because these banks historically trade at low teen multiples, literally a 13 times next year's net income. And they print net income. It's one of the, too big to fail, one of the safest banks. They're literally making like 14 billion of after-tax net income a quarter. So yeah, that's how they can pay a dividend. They do share buybacks. So yeah, JP Morgan is one of the better banks. Let's see if there's any news around here. JP Morgan warns AI could impact 40 to 150 billion in US collateralized obligations. All right, anyway. So yeah, JP Morgan's pretty cool. All right. Thanks again for that gift there. Let's look at Broadcom and then we'll do HIMS. I have not seen the HIMS news. So let's definitely check that out. Thanks again for that huge gift there, Isaiah. Hope you're having a good day. So here's Broadcom right here. This is a TPU play. They're making these custom chips. I think Google's like one of their biggest customers. Let's see. There's a lot of news here. All right. I'm trying to see if there's anything like notable here. One thing that's showing some weakness kind of is their VMware business. People are like starting to get annoyed with it, and there might be a little bit of churn. They're saying authorized a 10 billion share buyback program. Anyway, let me just show you why I really like Broadcom. It's a quality name. If you look on the left, they look stupid expensive at a 64 PE, but you got to look at their forward numbers because they're so growthy. They're literally going to double their EPS in the next year because the PE is going from a 64 to a 31. So you really got to do like a 2 or 3 year out multiple, and they're like a 24 or something. But yeah, 31 forward PE is starting to look pretty fair. A lot of people know them for their semiconductor solutions, which is finally starting to pick up like a lot of growth. Like if we look at all the growth rates before today, it used to be like single digit, like 4, 3, 3, 3, but this quarter of 35% after grew 12, like that's incredible. This quarter specifically, how it was 35%. And also they have their infrastructure software. Like look at that kind of annualized. Like in 2023 was 7.6 billion. 2025 it was 27 billion. Just this quarter it was $7 billion, it's up 20% after it grew 195%. So it's just continuing that growth. That's hard to do, and it's impressive. And the analysts are seeing the net income. Yeah, that's why the forward PE is so low. So yeah, this is why the forward PE is so low, because look at their net income projection. It's literally going to go from 4.14 billion to 11.99 billion. So literally they're going to make $12 billion in net income in 2 quarters. And that's like close to 50 billion annualized. So yeah, they're close to like a 25 2-year out forward PE, and they print free cash flow. Like, one thing right now is like a lot of companies' free cash flow is hurting. Well, not Broadcom, because they're the one that people are spending their free cash flow on their chips. So yeah, they're making easily like over 7 billion of free cash flow a quarter, record free cash flow. That's what you want to see for a stock you want to buy and never sell. And you get a nice dividend 0.7% dividend yield. Good net income too. So yeah, I really like Broadcom. I'd be a little careful though, because it's not the I'd nibble on their company. I wouldn't go crazy yet. Yeah, hey Steven, it's very first link in my link tree there. If you want to get this app I'm on, it's a brokerage. I remember you had Coke stock. It ran up 70%. Do you know anything similar to it in the sector? No, I actually don't. This is like the only this is a bottler. So this isn't the main Coca-Cola company, but an interesting one. You know what? I'll actually cover this stock right here. This is Vita Coco. I guess I'll just cover it because I found it interesting. They actually, and then we'll do Hims after this. My bad. Yeah, Hims for sure after this. I'm going to check out that news. But yeah, Vita Coco, they have a 45% market share for coconut water in the US. And it's hard to get market share. You know, the most competitive industry, Vita Coco has a 45% coconut water market share in the US. And, beverages are really a net margin game. And they actually have some pretty decent net margins, like they're making good net income every quarter. They actually have no net debt at all. So, and if we go to Vita coconut water growth specifically, this is what you want to see. Last quarter was up 42%, but it's up 9% year over year after grew 30, after grew 8%. And we actually just bought some Vita coconut water. So, yeah, 77% comes from the US. And then they private label it out too because they own their own bottling facility and stuff. So anyway, I just like that they're making net income every quarter and they already have a big market share. I use their products. So yeah, just kind of like a niche coconut water beverage play. But yeah, I mainly like Coca-Cola Consolidated. This is the bottler for Monster, Dr. Pepper, and Coca-Cola. Largest one in the US, biggest bottler for Monster and Coke. All right, let's do Hims real quick. I did not see the news. I remember they acquired a company called Eucalyptus Pharmaceutical. Whoa, hold up, check that out. They're up 40% after hours. We got to check out the news here. Novo Nordisk and Hims & Hers helped to end their legal dispute, and they form a partnership on obesity drug. Oh my goodness, you're kidding me. Novo Nordisk has been struggling almost worse than Hims. Look at that. This is the company, by the way, Novo Nordisk, if you didn't know, they own Ozempic and Wegovy. This is your pure weight loss play. They literally own they're the largest market share. 93% of the revenue is through diabetes and obesity care products. And what happened recently, before today, there was a big headwind for Hims because they released they used to sell, this is crazy. They used to sell Ozempic and Wegovy. Hims & Hers used to sell it on their website. Then Novo Nordisk ended the partnership with Hims & Hers. Hims & Hers now goes and makes their own knockoff version. And then Novo Nordisk sues Hims & Hers. That's why they dipped this day, because they made a knockoff version. The SEC and FDA investigates them, and now they're forming a partnership, ending all the legal disputes. That's just crazy. So no wonder they're up 40% because it was such a drag on the stock. So that's quite interesting. One thing I've liked about this stock is how much their top line grows and their subscription business. So check this out right here. If we just zoom out to the revenue, this is what you want to see. This is why some people are interested in this stock, because they really have good top line growth. One reason why they've been struggling is because the past couple quarters, they haven't been selling any weight loss prescriptions, and it's really hurt their top line, their bottom line, their actual profits. Good thing they're still making net income every quarter, but their margins is really what's getting collapsed. But it's great to see that issue fixed. They also, I think they have 2.2 million subscribers that pay them every month, every year. They're getting into hormonal products. They just acquired a company called Eucalyptus Pharmaceutical. That's why they took on so much leverage. They used to be a debt-free company with a fortress balance sheet. But then they took on a lot of leverage after they needed to out-innovate because they weren't able to sell weight loss stuff, so they took on a lot of debt. That was kind of a long answer for Hims & Hers, but that's quite interesting. All right. Oh, dang. Cruz says, I can't believe I sold my Hims right before the news. That always happens to us. Wow. Partnership to knockoff to lawsuit to partnership. That's comedy. Exactly. Yeah, that was insane. So, you actually laughed. That's just so insane. Yeah, congrats if you owned them before today, because they've been struggling a lot. Okay. Thoughts on Berkshire Hathaway? Yeah, this is an ETF in one. I believe they, or let me go to Berkshire Hathaway B. Their operating earnings, actually, they've recovered quite nicely. So they reported earnings and they're operating income fell like 20 or 30% year over year, but I love their portfolio. They fully own a lot of companies. Like they fully own Geico. That's this insurance business right here. It actually does over 104 billion of annual revenue for them. They're in manufacturing, McLean, Pilot, like the gas station. They own Dairy Queen. Oh yeah, they own BNSF Railroad, and they own a bunch of stakes in a lot of companies like, Apple, American Express, Google, a lot of these kind of companies. So, let's see. Yeah, it's basically an alternative to the S&P 500. You should just get like 8% to 10% of your money back every year with this company. So yeah, it's a great, great investment, I think. Very diversified. Yeah, nothing bad to say about it. I know Warren Buffett he's now no longer working for them, or he stepped down as like the CEO. James says, I do not own it, but what do you think of MAMA stock? Mama Creations. They're actually on my watch list. I don't even remember this company, but dang, they've done incredible. Hey, what up, Aaron? We'll look at Marvel after this. Yeah, they had great earnings. Marvel did. Hey, thanks, K2. He said subscribed. I appreciate that, man. Yeah, if y'all want to hit the follow button, we stream every day. I sell nothing. I have no course, book, WhatsApp. I don't coach. I do nothing. I'm just trying to give my opinion, nothing financial advice. So here's Mama's, but if you want to help me out, hit the follow, hit the like button if you want. So here's Mama's Creations. So they're only worth $675 million. So it's a very small company. But here's the thing. Wow, that's great top line growth. Revenue grew 50% year over year. Let's zoom out. That's incredible. So record revenue this quarter, 50 mil of revenue. That's a nice trend. And on that 50 mil, they're actually making net income every quarter. So out of all the companies that are worth like $650 million, I want to own the one that's actually making net income every quarter, not losing money, has good top line growth, pretty good balance sheet too. Let's actually see what they do because I actually don't remember. It says packaged foods is the industry. I'm just purely judging them off their financials. So hey, maybe it's like a grocery store, or they won 2 QVC awards. I guess here's the industry. I don't know if they're like a restaurant or a grocery store, but I'd still keep that one really low as an allocation because they're only worth 600 mil, pretty small. Oh, Warren Buffett's still the chairman. Oh, thanks for that. So next up, I wanted to pull up Marvel because, yeah, they did just report earnings. So Marvel Technologies, they were up 19% on Friday when a lot of stocks on Friday, or semi-stocks specifically on Friday, fell. Like NVIDIA fell on the export news. Like other countries need now our permission to buy NVIDIA and AMD chips. So that's why NVIDIA fell 3% on Friday. Let's see if that'll pull up in the news here. Oh, well, check this out. Marvel reports Q4 earnings, revenue beat, raises fiscal 2027 guidance to $11 billion, and fiscal 2028 outlook to $15 billion on AI chip demand. So when they raised their guidance all the way out to 2028, that's just a lot of long-term stability. That's really invaluable to the stock. So that's great news. And they're finally, oh wow, look at those projections. It's going to go from $2 billion to $2.5 billion. The net income looks great. Yeah, they beat like crazy. They expected 294. They did 394. So they beat by $100 million. It hasn't loaded in down here yet because they literally just reported this. But yeah, this is their Q4 earnings. Really was a nice quarter. And look at the expectations of EBITDA. It's going to go to 940 million in 2 quarters. So there's just a lot of future growth to this name. And that's why I think they're being rewarded because there's just a lot of long-term stability there. And they rose their guidance. Great news. Let's see. Hey, what's up, Cole? And then Novo Nordisk is only up 2% after hours. Yeah, I guess HIM's because of the lawsuit. Really, okay. What should we look at next here? Buying NVIDIA the first thing Monday. Yeah, actually, NVIDIA is pretty decent. But there's one thing, it's like the law of large numbers, or let's see. Oracle and OpenAI abandoned Texas data center expansion. It's kind of like a direct hit to NVIDIA. Meta in talks as NVIDIA facilities deal. What does that mean? It's paid $150 million deposit to Crusoe. Okay, anyway. Oh yeah, but here's the bad news. U.S. considers global permit system for AI chip export. So you want to, if you're don't live in the US and you're trying to buy Nvidia chips, you need express permission now, which is not great. Let's see, Nvidia to invest 4 billion in Lumentum and Coherent to secure optical component supply for data center infrastructure. That's genius. Here's the thing, Nvidia's buying so many companies right now. If you didn't know, here, I'll actually show you this right here. Nvidia's so big, they own some individual companies. Here's the Nvidia portfolio right here. Intel, CoreWeave, Synopsys, Nokia, Nebius. So they own a lot of those kind of stocks. And now they're buying Lumentum and these other companies. But anyway, look at the forward multiple. Here's why I think, even though the law of large numbers is real, like, here's the bad part. They're worth 4.3 trillion. If you buy the stock, for you to double your money, they have to be worth 8.6 trillion. Now, that being said, I still think if you buy the stock today, you're going to get 8 to 10% of your money back a year on average, hopefully for the rest of time. But it is one thing to keep in mind. But here's why I think Nvidia's not done. First off, they beat like crazy this quarter. Analysts expected 35 billion net income. They did 43 billion. And then in 2 quarters, they're expecting 46 billion. Look at that year-over-year comp. They're still going to see basically 100% year-over-year comp growth to EPS. Net income is going to go from 26 to 46. And that's assuming they don't beat on net income. Like, that number annualized, that's 200 billion of after-tax net income annualized. It's just insane. And they just have insane free cash flow. So no wonder they're doing all these investments. They have a huge GPU market share. It's like basically the picks and shovels plays of this whole AI boom. And hey, dude, Isaiah, thanks again for that huge gift there. Hey, dude, thanks so much. He says, can you check Power Solutions again? I missed it the other day. Yeah, let's definitely check it out. Power Solutions. And yo, shout out to Aaron. So, dude, thank you so much. He said, thank you for the analysis. Man, I really appreciate that super chat. If you have another stock you want me to look at, please let me know, Aaron. I really appreciate that, man. What is this app that you're using? Yeah, hey, this is actually a brokerage I'm on. If you want to get it, it's in the link tree in my bio there, the very first link there if you want to get it. It's actually an affiliate link. So if you go and like deposit $100, we'll both get like a free stock. It's a free, actually, I'm not sure what app you're talking about. All 3 of these are all brokerages. They're all in the link and they're all in my link tree there. But out of all the apps I recommend, they're all free. They all cost nothing. Well, actually, some of these you have to pay like $4, $5 a month. This one I recommend the most because it's free, best analysis tools, and it gives you a 3.35% APY on your idle cash. So yeah. Okay, let's see here. What was I looking at? Yeah, Power Solutions. I do own this stock, full disclosure, so I am down pretty bad on them. Let's see. We're not too bad. We're down 20% on them. They reported earnings, and I was actually very happy with their earnings. This kind of reminds me of like my next Powell Industries a little bit. If we look in the top right, they're very small. They're only worth $1.2 billion, but that's what I like about them. They're only worth $1.2 billion, and they have a fortress of fundamentals. Like, check this out. The forward PE is a 12, so they're only trading at 12 times next year's net income. Like, I think that should definitely, it should be where it was a month ago at like a 16. So because of the earnings, like here's what they just reported. Analysts expected 169. They did 191. So they beat on revenue and they beat on EPS. They expect, or on net income, they expected 14. They did 16. They beat on EBIT. They expected 17. They did 24. So it was a triple beat quarter. I just don't know why they fell. I mean, I don't know if they like lowered guidance or something, but I think it's just how the market is right now. Oh, they just bought a company. I remember, maybe the market isn't too happy about this, but I'm a fan of this. Power Solutions actually, or PSIX, just bought this metal. Oh my gosh, it's not gonna show it now. But they just bought a company. Yeah, they acquired metal and steel manufacturer, MTL Manufacturing Equipment, for like $400 million or something. I don't know if that's going to be decretive to EPS or whatever, but I'm certainly not selling out of my shares. The 12 forward PE, I mean, that wouldn't be. Again, and this is stock I kind of recommend you have as a small size position. Like, you wouldn't want to have this one as like a big, meaningful size position in your portfolio. But I think it's worth having like a little bit of money. So DTU said Palantir stock. Yeah, let me do Palantir. Think AMD keeps falling, really want an entry. Hey, I do own AMD. Hey, what's up, Vulcan? And Larry, what's up, Larry? VIST. Yeah, hey, I'll check VIST out for sure. Hey, we looked at JP Morgan as like one of the first stocks, but we'll definitely check out JP Morgan again. I got you, Marcus. So here's Palantir. This one's actually benefiting from the Iran conflict right now. Oh, look at this. Yeah, Palantir cited as a beneficiary of Middle East conflict as U.S. defense AI demand goes up. Palantir wins $1 billion U.S. Homeland Security software contract. So that's pretty insane. Yeah, they post 70% revenue growth. So a lot of Palantir's revenue actually comes from the government, 53% of it. And it's growing incredibly. Like this is what you want to see for a growth stock. It's up 60% year over year, after grew 41, after grew 10. So the growth rate's growing. Like notice 60%, that's the highest growth rate on the entire screen. So no wonder they have this like incredible stock price appreciation. It's not just momentum. It's like the real fundamentals are improving here way more than analysts ever thought. Like look at these net income beats they do every quarter. And it's not just the government revenue that's growing on Palantir, but also the commercial side with other S&P 500 companies like GE Aerospace and Google that grew 82%. Like that's also the highest growth rate on the entire screen. 82% growth. Like after it already grew all this amount, it's so impressive, and they really do deserve all the hype around them. But the bad news is, I'd love to own them, but they're really expensive. They're only at, they're trading at 130 times next year's net income. That is sliced in half from the current PE though. So they're having like this year's 100% growth rate. So you really look at a PEG ratio, but they are still quite expensive. And I'd love to own them, but I'll probably never get the chance to own them because they'll never get to a valuation I'm okay with paying. But they always deserve an extremely high premium because of their like premium fundamentals. Like they're the top dog. All right, let's see what's next here. XLE, is that just an ETF? Yeah, so if you're looking for energy or want to buy specifically energy stocks and you don't know which one to buy, like do you buy an Exxon Mobil, an EOG, a Chevron, or well, let's see what it holds. Yeah, an Exxon, a Chevron, a Conoco, EOG. You could just buy this ETF right here. It breaks your money up for you into all the market cap weighted oil and gas names. So yeah, look at that. As we know, if you've been to the gas station recently, the prices are up like, I think across the nation, up like 30, 40 cents. So some people are saying it's a good time to short oil. I really don't know. It kind of just depends on what's happening with the war. We really need the war to de-escalate, open up some of these shipping routes again. So, but yeah, that's an interesting ETF. Yeah, NVIDIA is very cheap. I think their forward PE is let's see what NVIDIA's forward PE is. A 21, dude, you can't make that up. Again, it's because they're still going to see 100% EPS growth. Net income is going to go from 26 to 46 billion year over year. So in 2 quarters, they're going to make 46 billion net income. That's why on NVIDIA, literally, they're trading at literally 22 times next year's net income. That's why I don't think we're in a bubble. Like all the valuations are fair. Amazon, NVIDIA, Meta, Google, their forward PEs are all good. Show that page again. Hey, I forgot what I was showing there, but I am also streaming on YouTube. You can like rewind it over there. My YouTube channel is called Nathan Robert. Oh yeah, hey, thanks for someone reminding me. Reddit, that was one of the stocks I was supposed to cover at the very beginning of the stream. So yeah, Reddit, yeah, I covered Robinhood, ARM, Symbiotic, Uber, and then BlackRock too I wanted to cover. But Reddit, this one I specifically wanted to cover because I think the risk to reward looks very fair. I am a shareholder. I got 4 shares there. It's kind of the blue line. So I might be biased when I go over this one, but I own them for a reason. And a lot of people think Reddit is just some meme stock, but they are no meme. I am seriously about to buy some more Reddit, and they did not get added into the S&P 500 like I thought they would. So, but that wasn't really a huge factor in the long-term fundamentals here. They'll get added in soon. But check out the growth here. Like this is why Reddit is underrated in my opinion. The revenue's up 69%, after grew 71, after grew 24. Like if we just zoom out to the revenue here, these past couple quarters specifically have been most impressive. And they're actually selling their data to train other LLMs, are selling their data to train other LLMs, and that's like 100% margin kind of form of income stream there. And it's not just revenue. So look at the revenue, 725 million. On that, they netted 251 million. Now, if we annualize 250 million in net income, that is, and again, that's a little more generous because they're only expecting 119 million next quarter, 170 million. But historically, they always beat on these net income numbers. But point being, if we annualize this to $1 billion of net income a year, the whole company is worth 26 billion. So that means they're only at a 26 forward PE. Analysts have it at a 31 forward PE. But here's the even better cherry on top why I think the risk to reward looks even better. Reddit has no debt. This is a debt-free company, and they have 2.5 billion of cash. And the whole entire company is worth 25 billion or 26 billion. But that literally means 9% of the entire market cap, basically 10% of what you're paying for this whole company is just their cash on hand. That's why I really like Reddit. It's known as one of the last real places on the internet. Let's see if there's any news. No news on Reddit. But I wouldn't recommend having this one as a huge size position. I only got 4 shares, but that, I really think they're like a 27x cash forward PE in my opinion. Let's pull up Iris Energy real quick. I saw Vulcan say this one. I don't love this one because of the long-term thesis. I still think like 85% of the revenue is Bitcoin mining. Short seller Jim Chanos questions Iris Energy's revenue guidance transparency. Well, let's see. Iris signs 3.5 billion GPU purchase with Dell for 50,000 NVIDIA chips. Wow. Anyway, what this company does, this is why I don't love the long-term thesis, but I still think they'll do good probably through the end of the decade. Through the end of the decade here, is that all this company does is they literally, there's nothing proprietary. They just own NVIDIA chips and data centers. No real proprietary anything, just literally they just own a bunch of chips. And what are they doing with those chips right now? Well, they're using them to mine Bitcoin. 90% of the revenue is still their Bitcoin mining company. But right now they're getting a lot of contracts. Like I think they got one with Microsoft where they're going to rent out the capacity of their GPUs. Instead of the GPUs mining Bitcoin, they're going to go to cloud hosting, basically cloud services, high performance compute. So dang, they missed on the revenue this quarter. And I was expected 224. They only did 184. But look at the future projections. It's supposed to be 316 million in 2 quarters. Anyway, it's kind of like a Bitcoin. Nothing's blowing me away here. It's kind of just like a smaller core weave. I personally don't love the long-term thesis on that one. Hopefully that was somewhat helpful. I don't know if people knew that's mainly like a Bitcoin mining company, but they're like converting into they're renting out the GPUs to cloud. So Harma said what happens is, hey, if you want to get this app I'm on, it's in the link tree in my bio there. It's the very first link. It's my favorite brokerage. So it's free. It's an affiliate link, full disclosure. So if you want to get it, link tree in my bio there. It's called Moomoo. You can just type it into App Store. Okay. Any good industrials? Yeah, Caterpillar is great. Let me check out Vertiv. What was VIST? I saw someone say VIST. Vistra Energy. Did they change their ticker symbol? Oh, there's Vistra Energy and Vista Energy. Okay, so this is a different company, Vista Energy. That's also done phenomenal. Actually, on the weekly, they closed at an all-time high. So if you've ever owned the stock, you got to be up on your position. Let's see what they do. Wow, that forward PE is very cheap, an 11. As we do more research, like when a company's at an all-time high and the forward PE is only 11, it can potentially stretch up to like a 14, a 15, and potentially this could be undervalued even at an all-time high. But let's go see. Revenue from crude oil sales. Okay, so that's why the multiple's so low. I thought this was in maybe like a data center, but this is like a crude oil company. And look where the revenue comes from. So this is an Argentina crude oil. So they must be headquartered there. Actually, they're headquartered in Mexico. That makes sense. Yeah. All right, so let's see what their bottom line is. And this is in US dollars. So they really are making a lot of money. Wow, if we zoom out, they really are making, if we average it out, over 100 million of after-tax net income a quarter. Yeah, and that's true. They don't pay a dividend. That's odd. They must be doing heck of share buybacks. That's why the stock has done so well compared to your average oil stock. This IPO literally in 2019 is $7 and now it's 70. So it's 10x. Actually, I'm going to put them on my watch list if you're looking for like an Argentina oil stock that doesn't pay a dividend. Let's see if they're doing buybacks. That's what I bet they're doing. Let's just go verify. Stock retirement. I guess kind of, yeah, 50 mil. Not too bad. What's the whole company worth? The whole company's worth 6.5 bill. Okay, 11 forward PE makes sense. It's an interesting one. I didn't know about that one, Larry. Thanks. Quantum stocks, ARQQ. Yeah, I haven't been too big of a fan on the quantum names. If I trust my quantum exposure via Google. Google has the money and the talent to be the industry leader when quantum pops off. And some like Honeywell's a good one, Microsoft too. They're already so far past a lot of these companies. I'm glad you didn't mention RGTI because that one's like one of the worst of them. But yeah, like you mentioned QBTS. Here's why I just can't trust these kind of stocks. Again, it's all like momentum and it's sentiment around the future around quantum. And hey, what's up, William? Good to see you, man. We'll check out InnoData for sure. And Isaiah, with the paper crane gift. I appreciate you, Isaiah. Thoughts on UHN? We'll check out UHN too. We'll definitely do that. So here's QBTS. If you look in the top right, they're worth $6.8 billion. Now, I know a lot of companies that are worth $6.8 billion, like Powell Industries is near that market cap. And here's why. Out of all the companies worth $6.8 billion, I don't think I'd want to own the one that does like $2 million of revenue a quarter. Like they did $2.75 million of revenue. I guess analysts are expecting it to go to, and dang, they missed expectations. I guess it's supposed to go to 4 and then 6 million, but they lose a couple hundred mil a quarter two of net income. It's just I can't justify the valuation here. But again, this is all you buy these stocks as this is a good trading vessel. Like if you just want to trade the sentiment around how quantum's doing. But those aren't buy and hold forever kind of stocks, in my opinion. What was the one I wanted to look at? Oh yeah, UHN. Thanks for that huge gift there again, Isaiah. Wait, I can't find. Do you mean UNH, Isaiah? Let me know if you mean UNH because I type in UHN or what's the name of the company? Harmy says Google. Let's do Google. And Eric with the 4 roses. I appreciate you too. Let's do Google really quickly because, this is like an ETF in one. It is a little quantum play as well. They own literally Android. They own YouTube. They own Waymo. Like they sell their own TPUs. Meta's buying their TPUs now. Let's see. Alphabet unveils strategic vision targeting quantum computing. See, this is why I say I didn't even know this was here. This is why I see them as a quantum play. So targeting quantum, robotics, AI drug discovery, and CapEx and they're doubling their CapEx. 70% is marked on data center expansion and core capacity, while substantially funding flows into quantum robotics and drug discovery. Google's Willow chip research showed quantum computers executing algorithms 13,000 times faster than conventional supercomputers. So yeah, they're already working on their quantum division. And here's why Google's at right now's valuation pretty fair. If you look on the right, they're only at a 25 forward PE. So they're only trading at 25 times next year's net income. That's why we're not in a bubble, and Google could probably most likely go back to all-time highs pretty easily. And if I was a shareholder, I certainly would not be selling. But one thing that's kind of putting a drag on their forward multiple is the fact that if we go to their cash from investing activities, they spent $51 billion just this quarter. They're spending way more than they're making. They made $35 billion in net income, and they spent 30 or 51 billion. But I kind of like that they're spending a lot of money. They're not going to get out innovated by AI. They are going to be the main AI play because Google Gemini's already taken over like crazy. But anyway, they projected they're going to spend, they spent 52 billion this quarter. They're going to be spending like $50 billion for the next 4 quarters in a row. So that's just one thing Wall Street really stays awake at night for 2 main reasons. And one of them is are we really going to get real returns on this spend? And that's what we'll find out in a year or two. But anyway, Google can afford to they make 20 to 35 bill a quarter, and they're going to be making that for the rest of time. So they can afford to burn through $100-200 billion. But that's just crazy numbers. And yeah, 25 forward PE. That's why I certainly wouldn't sell Google. I am a shareholder of Google, full disclosure. They're my 3rd largest holding because I trust them so much. And I've never trimmed or sold a single share. I'm up 82%. Great dividend grower too. They just started paying a dividend. They do share buybacks. Yeah, I guess we get a little $3.99 dividend from Google every quarter. But yeah, Google's pretty great. And I love Waymo too. And the Google Cloud, I even mentioned the Google Cloud and they just acquired Wiz, which are going to be in the top 10 cybersecurity plays in the whole world now with that acquisition. Look at just the Google Cloud. Google Cloud's up 47% year over year. That's the highest growth rate on the entire screen. They actually took 1% market share away. They gained 1% market share. So I really love Google. All right, United Health Group, UNH, yeah, let's do it. United Health Group. Yeah, so I don't love this one just because it's so much in the government's hands with the Medicare, Medicaid stuff. The government did not, they were expecting a 6% price increase, and the government said, no, y'all get 0% price increases. And I've watched this stock for years, and every time they either go up or down, it's sometimes not, it's almost always not up because of earnings. It's because of what the government's doing with them. So they're just so heavily reliant on the government. And one thing that's bad is their net income. This quarter, they were expected to make 1.5 billion in net income. Well, look at this. They only made 218 million. So we're seeing this margin collapse happening where they used to make this consistent amount of net income, or really we should pull up the operating profit to exclude that one-time adjustment. Look at that. Historically always making 7-8 billion a quarter, but look at these past 3 quarters specifically, a massive decline in their real profits. And that's what I'm kind of scared of going into in the future. I'm also, we're a customer. We use OptumRx. I think that's growing insanely. In 2021, it was 35 bill. Now it's 155 billion, growing nice single digits, but it's just a margin issue. Yeah, look at this. Just basic metric here. Gross margins are down 22% after they fell 10%, and net margins are down too. And that's because, back in the day, it was kind of conspiracy and it kind of came out to be true. and I don't remember it exactly, but they were kind of overbilling the federal government, like almost certainly. That's why their margins were so high. Okay, do you recommend any other dividend growth stock than Visa, Mastercard, and JP Morgan? Dividend growth stock. Yeah, there's a lot of dividend growth stocks I like. But do you mean specifically? Let me know, Marcus, if you mean specifically in like the financial tech industry, because those are all like, Visa, Mastercard, J.P. Morgan. Trying to think of any other good ones that have good dividend yields. Oh, BlackRock. Yeah, dude. Oh, that was the last stock I wanted to cover. Yeah, I have an interesting pitch for BlackRock for you. As we know right now, private credit is kind of being questioned right now. Let's see. They're actually limiting withdrawals. Let's see if we can find this right here. BlackRock caps redemptions. So people literally, they're capping withdrawals after a lending fund. Oh, so someone was trying to withdraw basically 10% of their entire $26 billion fund. I guess that's why they had to do that. But it's just not great sentiment for the industry. But that's just one part of their business. Still a big chunk, like 33%. But one business I specifically like on BlackRock is their alternatives revenue. And this is actually their crypto ETFs. They actually just released this around a year ago, or a year and a half ago, the IBIT ETF and like an Ethereum ETF. And this is under their alternatives business. And check out these growth rates the past 4 quarters in a row. 35% after 45% growth. Last quarter grew 119%. And if we just look at that on an annual basis, look at that full year jump of revenue. Full year 2024, it was 1.7, and it's basically it's up 71% to 3 billion. So again, that's just one little portion of their revenue. Let's see, technology subscription revenue. Look at that. That's at a record revenue right now. It's up 24%. This is their recurring subscription revenue. Active multi-assets. So I just like how diversified that they are. They still make good net income. They had a one-time adjustment this quarter. Since their net income fell 25%, they had a one-time like realized loss on something. But anyway, the core operating profit grew 9% year over year. Is still great. I think it was near basically record ever profitability. Yeah, it was record ever profitability. It had never been a more profitable quarter technically before tax and before adjustments. So yeah, BlackRock's pretty cool. And look at the forward multiple here. This is another cool thing. 17 forward PE, not too shabby. All right, let's see here. Oh yeah, SoFi, that's a great one too. Unfortunately, they don't have, Innodata. Yo, William, my bad. He said Innodata. I wanted to get to that one. This one is actually tied a little bit with Palantir right now. Speaking of Palantir, they got a huge like revenue share agreement where they're actually partnering, or they got a huge federal Golden Dome contract. They're seen as one of the few companies that get like permission to work with the government. So anyway, they have they have a data labeling solution. So their digital data solutions right here have been growing incredibly. Some of their biggest customers are literally Google, Meta, Amazon, Microsoft, and Nvidia. I believe those in order are like their 5 biggest customers, and they've been crushing expectations every quarter. Like they expected 69 mil this quarter, they did 72, and it's supposed to go to 79. That'll be a great increase from 58. Same with net income. They expected 7.5 mil, they did 8.8 million. But what I think is cool is this market cap. Like this whole company is worth 1.47 billion. That's what I like, that the whole company is only worth 1.47 billion. I want to buy the company that's worth 1.47 that's making this sort of net income, where they're making like close to 10 million net income a quarter. The revenue's growing very fast, and this is all organic. Like they didn't do an acquisition to get this growth, just a core business that's growing, and they have no net debt. So it's just one of my favorite like smaller companies. Like I don't own many of these, like a $1.5 billion company, like Innodata, Power Solutions. Those are like my main two. And I just love this company. They also have a huge partnership with Palantir where they're going to collect a part of Palantir's government revenue. So yeah, let's definitely look at SoFi. I own this company as well. I think you're going to be impressed by their numbers right here. Innodata reports earnings this week. Oh, I can't wait for that then. I'll be watching that. So here's SoFi Technologies. Here's what I think is very fair. Actually, there should be some news there, like the first ever U.S. bank, because they have their own banking charter. They got it through a loophole that's now patched because of them like years ago. But yeah, SoFi partners with MasterCard to enable SoFi USD stablecoin settlement across global payment networks. So this is like really real now. Oh yeah, the SoFi CEO purchases 1 million of the company's shares. SoFi Bank launches SoFi USD Stablecoin. It's the first U.S. banking charter or chartered bank to issue a stablecoin on a public blockchain. Pretty cool. And check out the forward multiple. Like they're just like the most innovative bank, kind of like Robinhood. Or Robinhood's not a bank. They have to partner with other banks, but SoFi is their own bank. Look at that on the right. They're a 28 forward PE. Look at how, like, if you look on the left, they're like, wow, they're pretty expensive, 48 PE. But no, they're so growthy. You always look at their forward multiple because, they grow 100% year over year. So the forward PE is a 28, and that starts to get very attractive. And a 28 forward PE for a company with this sort of growth, I think, is very fair. Specifically, you look at the financial services, check out these growth rates. It's up 78% year over year. After grew 85, after grew 141, after grew 287. Like, that's insane. Like, I did not expect these numbers, and analysts didn't expect that sort of growth either. And we can see the analyst expectations. For the past 3 quarters in a row, they beat on revenue every quarter. They beat on net income every quarter. And notice the net income is going to go from 97 million to 197 million. So great year over year comps. And that's why I think people are really starting to take SoFi serious. And like, there's more, like, analysts are really expecting more growth. So 28 forward PE. That's why if I was a shareholder, like, certainly don't sell out. Like, the risk reward is so good. I think they're pretty close to their bottom. That being said, if I wanted to own SoFi, if like you didn't own SoFi and you wanted them as like 5% of your portfolio, you don't make it 5% of your portfolio today, but you maybe go ahead and make it like 1% if you are comfortable, or, whatever that size position for you is. So hopefully that was kind of helpful there. Hey, what's up, Dat One Dude? Thanks for showing up to the YouTube stream. He said AMPX. So Ampress Technologies, they're on my watch list. I actually found this company really interesting, and I can totally understand why they're at an all-time high. Thoughts on Walmart? Oh, we'll definitely check out Walmart. I just got a Sam's Club membership, so bullish Walmart maybe. But yeah, Ampress Technology is at an all-time high right now. Check this out. So they sell batteries. This is really the reason they're doing so well, is they've gotten their first ever sort of revenue, because the company was a tough buy a year ago. They only did like 3 mil of revenue a quarter, but now they did 21 million of revenue. Great triple digit growth for the past 5 quarters in a row. And look at what analysts are expecting. It's supposed to continue to climb higher from 15 mil to 27 million. So as long as they keep beating on revenue expectations like they have been, the momentum will probably continue to climb higher with this name. I wonder if there's any sort of specific news, because they were up 10% on Friday. Let's see. Ampress sourced to all-time high on price target hike after earnings blowout. So they must have had great earnings. Yeah. So here's what they were. They expected 22. They did 25. The EBIT, so they were expected to lose 5.2. They only lost 2.9. So they're losing less than expected. So yeah, look at that net income narrowing. So they used to lose 10 million. They only lost 3 million this quarter. That's like nothing. So I can totally see why they've done so good. Yeah. Congrats if you own that stock. I don't know. I don't think I'd buy them at all-time highs, but it's one I'd probably keep as a small position. I probably wouldn't trim or sell them if I owned them too. So Walmart, surprisingly, Walmart's done phenomenal. It's kind of like really been defensive, like, as the tech AI stuff has been struggling the past couple months, but Walmart's done great because they're seen as like a safe haven defense name. Like in 2008, Walmart and McDonald's were the 2 best performing stocks in the S&P 500 that year. Let's see if there's any news. Okay, not really. But yeah, this company just prints money. It's unfortunate because they're really expensive. Like, I'd like to own Walmart, but look at that. They're at a 42 forward PE. So that's like more expensive than all the Mag 7 except Tesla. But I really like what they're doing with Sam's Club. We just became a member. I love their food court. Like, it's kind of like a copy of Costco, where Costco has this, it's a genius business model. You have to have a subscription just to get into the store. Whether or not you go to the store, they're collecting that subscription revenue every single month. And, and customers are happy to go there because, they have the loss leaders like the $5 rotisserie chicken, the food court, all that. But here's their after-tax net income. They really do make like 5+ billion of net income a quarter. So it's a great never sell name, but it's so tough to buy it today because, yeah, they're worth $1 trillion. So it's a tough double at a 45 forward PE, but it's just a safe stock to buy and hold for the long run. All right, what's next here? George said MongoDB. Hey, this is a software name. I think they're like a subscription software company. Hey, what's up, Matt? We'll check out Constellation Energy. Someone said Orchard Island Capital. Yeah, that's one I'd stay away from. Okay, so here's MongoDB. This is a subscription software company. Actually, I didn't know that. They're actually the same price as they were in 2020. So they've been flat for 5 years. Let's see if there's any sort of like specific news. Okay, I don't see any specific news. So, other subscription revenue, how's that doing? So, I guess their other subscription that actually went negative year over year. That fell 7.3%. But their main MongoDB Atlas, that grew phenomenally. That grew 29% year over year, after grew 26%, after grew 35, after grew 61. So, that's really the real winner here. So, it's kind of like a mixed bag. Their main business is doing amazing, but I guess their other subscription revenue is kind of struggling. But they still beat. They beat on revenue. They beat on net income. Also, they're just getting profitable. Yeah, if we zoom out, they used to lose a lot of money every quarter, like 20, 50 million. But now it looks like they're consistently going to be making net income from now on. They actually made 15 million this quarter. It hasn't loaded in down here yet because so that's why they fell, because they reported earnings. That's why they gapped down. Um, so it was a great quarter according to the analysts. They beat on every single metric. They beat on revenue, net income, EBIT by a good chunk, but the stock still fell. Maybe they lowered their guidance or something. I'm not sure. Uh, I'm not too sure. Maybe they're just part of the SaaS apocalypse, one of the software names that might get taken over by AI. I'm not too sure. Hey, shout out to the homie Looney, the member actually. Dude, what's up, man? I hope you're having a great day. He says Adobe releases earnings next week. Let's check it out. And then we'll check out some of these other names. Sorry, again, if I do apologize if I'm missing your stock. I'm trying to get to all these here. I'm reading both chats. So Adobe. So Michael Burry just went crazy. He just bought a lot of Adobe stock. Michael Burry urges Adobe to acquire AI firm Midjourney. Dude, I use Midjourney. Well, I have. Don't use it anymore, but I'm in their Discord. So to acquire Midjourney to defend market position amid competition from Google's Nano Banana 2. So yeah, Google's, I guess, competition. So just AI is a competition for Adobe. So the thesis is the bad news is this is why the stock has been, crushed the past 2 years. The sentiment around this name is they're saying in 10 years from now, will we need Adobe? Will we need After Effects? Or, why do I need Photoshop if I can just AI generate this photo or this thumbnail or whatever? But I'm always a believer that humans are going to need the final touch on art. Like you always want that human final touch. And maybe this goes from a not so much of an AI loser as people thought, and maybe this sends us one way higher because the multiple is dog cheap. Like it's almost like the worst is priced in because they're only at a 15 forward PE. So that means you're trading at 15 times next year's net income. Subscription revenue, yeah, they have a crazy, like their subscription revenue, ARR just keeps on going higher, and they have a backlog. So if we go to their net income right here, like this is why like the stock is tanking every quarter. It's not because of the financials, because every quarter they beat like crazy on net income. They beat like crazy this quarter. It's just the sentiment around Adobe that's making them fall. So they're making 1.8 billion in net income a quarter. Since Adobe isn't really doing any acquisitions right now, they're actually doing insane share buybacks. Check out the top. They're doing literally 2 to 3 billion of share buybacks a quarter because their stock is so cheap. So let's hope that was the software bottom like 2 weeks ago. It's really looking like it was. Knock on wood, fingers crossed. But it's very interesting. I guess we'll see what happens this week with Adobe. And actually, I like that Michael Burry is urging them to acquire things because I think they should do that too. They just stop buying back their own stock, acquire a business, spend 10 billion buying a company or something, or take a stake into Anthropic or whatever, So to not be, to fix the sentiment around them, Hey, what's up, Emperor Penguin? Can a non-US citizen invest in a USA dividend stock like BlackRock? Yeah, you can. Sometimes you have to buy like a ADR. But yeah, so Dish said ARM. Hey, that was actually like the second stock we looked at on the stream. So I'll be kind of quick with ARM right here. They make energy efficient chips. I really, really like ARM. I don't think there's any news around them. But let me show you what I find fascinating about this company is that their margins, their gross margin is literally a 97% gross margin. Why? This is because they are a licensing and royalty company. Literally 62% of their revenue is their royalty revenue, and then they collect licensing revenue as well, which as we know is extremely high margin, literally 97% gross margins, and then trickles down to like a near 15, 20% net margin. So they're making around a couple $100 million net income a quarter. The bad news, though, is that they are pretty ridiculously expensive. Again, it's a business model I'd love to own, I'd happily own, but at the right price, because it's tough to pay 107 forward PE, but this company deserves a high forward multiple because they're really quality. They really are. They're kind of flat from their IPO price. So hopefully that was kind of helpful. Scroll back to the it's the second stock I looked at, I believe, on the stream. If you want to see a different analysis on them. Hi, is there any ETF with the high dividend that you know of? Yeah, hey, what's up, Wok Tongue? Good to see you. So a higher dividend ETF, I don't know what you consider high dividend, but I really like VPU. This ETF gives you 2.8% in dividends or nearly 3% dividends. So here's how this ETF works, in my opinion. You get 3% of your money back every year in a qualified dividend. And then you also get 3 to 4% in stock price appreciation. So you should get an 8%, 7 to 8% total return every year with the VPU ETF. It owns a lot of the utility, or just it's a utility play. And regulated utilities like it owns NextEra Energy and Southern Company and Constellation Energy, which all have pretty high dividend yields and give you good stock price appreciation. So, but if you're looking for, and again, I can't even call these dividends because technically these are called distributions, but there's things called covered call ETFs where they sell calls on stuff, and this one sells calls on the NASDAQ. So this one actually pays you a monthly, it's called a distribution. They can't even call it a dividend because it's actually not even taxed as a dividend. It's taxed at short-term capital gains and not long-term capital gains like VPU is. So you do pay higher tax on this. But they have a crazy 10% monthly paying dividend. And this is probably my favorite covered call ETF. But again, buying this ETF, you will not outperform the actual QQQ and the S&P 500 in the long run. But it's a way you can buy that to maximize your dividend income. And there's some individual stocks. And hey, like Matt said, CEG, let's pull up CEG because this one, hey, Nate, thoughts on Disney? Are they a buy? Hey, and only Jamaican King. Dude, thanks so much for that gift there. What's up, dude? Hey, appreciate that, man. Thanks for the gifts. We can check out Disney too, for sure. How about ASML? Yeah, we could do ASML. That's the lithography company. Best consumer staple. I really like Procter & Gamble. Actually, I want to come back to Procter & Gamble stock. So here's Constellation Energy. I do own this one. This is my favorite utility. They're an unregulated utility. Let me show you my position. Yeah, I got 15 shares in them. I am still up quite a bit. I'm up 55%. They're an all right buy. They're not the best buy yet today. Like you want to definitely buy this one under $300 because yeah, they're already up 20% the past month. But this is your number one nuclear play. They literally own over 30% of all the U.S.'s nuclear reactors, and they just acquired a company called Calpine. But before this Calpine acquisition, literally 70 to 80% of their entire revenue is their nuclear assets business, which I think is phenomenal. They're a little expensive. Yeah, like this is why I wouldn't buy them today. It says they're at a 43 PE, but the forward PE is only a 31. So, not too shabby. And it was just like a 28 or like 2 weeks ago. But yeah, 31 forward PE. I just really like the long-term outlook for this one. And it's like the infrastructure, like the NVIDIA CEO, the biggest bottleneck right now is getting the energy infrastructure and having the energy at a reasonable cost to actually run data centers profitably. So CEG is a great one. And, they literally have a nuclear reactor that they just partnered with Microsoft with, just powering one Microsoft data center. The whole reactor is dedicated toward that. And I'm not a big fan of the SMRs. Like a lot of people talk about Oklo and these small modular reactors, nuclear stocks. They're all pretty junk. There's only 2 working small modular reactors in the world, and neither of them are in the US. It's like oh my goodness. They're saying I'm AFK. Okay. All right, sorry if that went blank for a second. But anyway, I'm just not a big fan of the SMR stocks. I want to own just the real big nuclear plants like CEG. They have these fully paid off, fully amortized nuclear plants built like 2 decades ago that just print net income every quarter. So yeah. All right, and I am biased because I do own that one. But yeah, best consumer staple, Procter & Gamble, I think. They own so many billion-dollar brands like the Gillette shavers. They bought them for like $50 billion. But yeah, they own so many brands. The forward PE is only a 21, so that's what's pretty fair. Like even buying the stock right now isn't like, I wouldn't call you crazy because it's a pretty fair forward PE, a 21 forward PE. Yeah, look how diversified that they are. They're in fabric and home care products, baby feminine products, beauty products, healthcare products, grooming, which is Gillette. How's that doing? It's up 2.4% year over year. But they own Old Spice, Tide, Huggies, like so many brands. And here's their after-tax net income. This is what's so great. They really do make legit 3 to 4 billion of real after-tax net income a quarter. You get a 2.8% dividend yield, and they raise their dividend every single year. So so you're basically, no matter what, getting 3% of your money back just in a qualified dividend every year. So let me pull up, what was that stock? Yeah, Disney. Let me pull this up over here. This one's kind of a boring one. Here's Disney. I own a little bit of them. I did trim like a little bit of, I did sell like a little bit of Disney for some profits anyway, they're technically the same price as they were a decade ago. So here's the thing with Disney, like you're not buying this company to outperform the tech-heavy S&P 500. Yeah, it's the same price that it was in 2015, which was 11 years ago. So I just like them for their streaming business specifically. Like they own ESPN, Hulu, Disney Plus, and they're like merging those three streaming businesses together. They just rose the prices on it. So the theme park business is low margin, high capex intensity. So I don't really recommend this one too much. They actually, one cool thing is they bought 0.5% of what you're paying. If you buy Disney stock right now, probably like 0.8% of what you're paying is OpenAI. They own a bit of OpenAI stock because OpenAI, they just had a partnership with them where they're actually going to pay Disney royalties to license out their stuff. Disney CFO announces sports profitability weighted towards Q4, merges NFL fantasy football with ESPN. Wow. Pretty cool. Warner Bros. Discovery Skydance merger creates major sports media competitor to Disney ESPN. Hey, that maybe is not good sentiment, but they traded a low forward PE, but yeah, like a 17 forward PE. S&P Global just rose their credit rating on them as good, and they have been raising their dividend. They pay a bi-yearly, basically they pay a dividend every 6 months instead of every 3 months quarterly. All right, that was Disney. Well, I own them as like a little bit of position. I've always been like, I want to invest in like experiences. Like I think in the future, like people want to pay for like experiences and memories. And I think Disney's a pretty decent way to do that. So, hey, Psycho said, can we look at Hood? Yeah, we'll look at Hood in a minute. If you go to the very beginning of the stream, the very first stock we look at is Robinhood and we deep dive into them. I think you'll like that one. So, would you buy Discord and OpenAI if they IPO'd? I don't know. If Discord's like Reddit where they have no debt and print net income, but I'm not a huge fan of, I don't know how Discord is going to make money. I think Discord Nitro is definitely not worth it. But I don't know. Microsoft already owns 27% of OpenAI. So if you buy Microsoft, it's like a proxy to OpenAI. Let's check out next. Oh, APLD. What's up, man? I also own ticker symbol YOU, Clear Secure. When would you look to exit? It's just such a small position for me. I'm actually not going to sell Clear Secure. Like, even though I'm up like 100% on them, they're a nice dividend growth stock. They have a 1.3% dividend yield, and I can understand why they did so good. Let me show you. Let's go over Clear Secure really quickly. This is that there's like no competition for them. There can't be. If you ever go into an airport and you see those, they're in federally regulated airports. You see those Clear Secure machines, the Clear Secure people where you just digitally scan your face and you skip the whole like TSA line or the whole line. So we pay for their subscription. We on the right, they're at a 29 forward PE. So that's pretty fair because they're expensive at a 41, but the forward PE is a 29. And I can see why they did so good this quarter. Analysts expected 235, they did 240. So they beat on every metric. They beat on revenue. Net income was great. They expected 26, they did 30. So excluding adjustments, like here's what we're working with profit. Like they're the most profitable they have ever been like this quarter. Profits are up 60% after it grew 117. So I've just been very impressed with Clear Secure. But I certainly wouldn't probably buy it today. But they're interesting. So, Drew, Verizon. So this is a dividend play. You buy Verizon to maximize your dividend income because technically Verizon stock is the same price that it was in 1998. So if you bought the stock in 1998, it's the exact same price that it is today. It's done great these past couple months though. Don't get me wrong. Like this has been one of the best like 2 months ever for Verizon. But you mainly buy this to maximize your income because historically, you get 4% in dividends and then maybe historically like no stock price appreciation on average every year, but you're hoping for like 1 to 2% average stock price appreciation on top of your dividend. But yeah, they really do have a safe 4% dividend yield. 10 forward PE. So it's just like a cell tower. It's kind of boring. Yeah, like the revenue growth, like it's low single digits, like 1% revenue growth, 1%. And they have a lot of debt, but all the like AT&T is the same. So anyway, I'm not just picking on Verizon. Like it's not just Verizon. That's the same price that it was in 1998. If we look at AT&T is also the same price that it was literally also in 1998. So it's kind of like this whole industry, like buying this industry, you're not probably going to outperform the tech heavy S&P 500 in the long run, but you get the nice higher yield than most companies. AEVA or Oust both produce LiDAR technology, which is exploding. Actually, I really like Ouster a lot. I was doing like a little bit deep dive on this one the other day. Hey, and then we'll look at BCAT. Yeah, we'll check out that one, Trace. And sorry if I'm missing some stocks here. I definitely want to check out these. I see McDonald's and Cameco and Hood I want to get to for sure. And ASML. Yeah, remind me to get to these because I might forget if it gets out of the chat. But here's Ouster right here. Yeah, a LiDAR play, which is kind of like a niche growing industry right now, like LiDAR, like the Waymo cars right now are like mapped out LiDAR and they have LiDAR sensors. And it's actually like winning versus Tesla's Cybercab. Um, model right now. So look at this. The sale of LiDAR production sensors, that's up 40% year over year. That's phenomenal growth. Like in the middle here, these year over year growth rates look great. We can even see the analyst expectations. Oh, they just reported earnings. So that's Q3. They actually sold 62 million this quarter. Analysts expected 41. They did 62. And they actually made 3 mil in net income on that. Was that true? That's really true. Oh my goodness. Yo, I'm actually going to add this one to the top of my watch list. That was actually a blowout quarter. How are they not up like crazy on that news? Oh, maybe part of that was from an acquisition. So valuation earnings upswing after Sterile Labs acquisition. So that might be what artificially sent the revenue up higher, was the fact that they did an acquisition. But it sent them net income positive and EBIT positive, like they really did make profits this quarter. I need to look into that more. That's pretty interesting. I do like their Ouster accelerates software adoption with record bookings and global expansion. These could be some fun articles to read. Anyway, I have nothing bad to say about Ouster. I just put them back at the top of my watch list. I do like that one. Let me check out Cameco for you. So this is their uranium play, and uranium is really popular right now because nuclear is back to being popular again. This is the number one, the best uranium company in the world, in my opinion. Oh, look at that. Cameco signs a $2.6 billion 9-year uranium supply agreement with India through 2035. Japan and U.S. working to include Westinghouse nuclear projects and $550 billion investment package. So all these new nuclear plants are fueled by uranium, and Cameco gets the uranium for you. So this commodity has just been such in demand right now. Unfortunately, they are super expensive. Let's see if there's any earnings recap here. So the uranium segment produced 21 million pounds, surpassing guidance with improved averaged realized prices. Wow, so that's great news. 230 million pounds committed under long-term contracts. Westinghouse investment exceeded acquisition expectations with adjusted EBITDA up 30% and substantial cash distributions for well results. Strategic partnerships with Brookfield, Westinghouse, and U.S. government aim to accelerate reactor deployment. So that's kind of some good sentiment around Cameco. Again, if they weren't so expensive, I might actually consider this name. I believe they're headquartered in Canada. Yeah, so they are headquartered in Canada. But pretty cool. That's like your best uranium play. Other one I kind of like is LEU. It's just because they make some pretty consistent net income. Like if we go to net income right here, it's kind of choppy, but notice like it's positive every quarter. There's not many uranium companies that actually make like net income every single quarter. Like sometimes it's choppy, but it looks great I think. Okay, BCAT, what was this one again? BlackRock Capital Allocation Trust. Oh, we said this is a dividend play. So yeah, they are down from 2021. So it's kind of like this. So you sacrifice basically stock price appreciation for dividends. So yeah, this looks like an ETF you buy to maximize your income. They have a 22% dividend yield. It must be, yeah. So they do some sort of like options. They do options to get that to get that income, I believe. So it's probably a covered call ETF. So, in 2021, it was $20. Now it's $15, but you basically buy it for the dividend. Yeah, they pay a monthly dividend. So, yeah, you probably won't like total return outperform the S&P, but it's a nice way to maximize income if you need that. Can you try Okta or underscore Okla? Wait, J-Bose, which one do you mean there? Actually, I'll check out Okta. That's a software company. Oh, let me do Western Digital real quick. I saw WDC, and then we'll get to some of these other ones. And ASML, yeah. So I use weighted S&P advanced. Okay, so here's Western Digital. This is one of the memory shortage plays. Let's see if there's any news around this company. Not really. Anyway, you really look at the future projections on this company because they're so bullish. I mean, they're incredible. If we go to net income right here, we'll look at this quarter specifically. They expected 647. They did 180, but we really look at the EBITDA to see the year-over-year comp. Earnings before interest and taxes, removing all those adjustments, like the profits are going to go from 730 mil to 1.3 billion. So there's a huge, like 50% growth expected. So if we really go look at the forward PE here on Western Digital, the forward PE is a 26. I'm assuming they had a one-time adjustment or, huh? Well, yeah. Anyway, here's the real profits right here, excluding all the adjustments. Has been growing pretty nicely. I kind of like the other memory shortage plays potentially better. Like I like Micron a lot. Micron might be the best one out there. Because yeah, look at it. Look, it's so cyclical. Like it's actually kind of the same profits as they were making. Like in 2014, 2015, they were making 500 mil a quarter. Then it kind of slowly declined, went negative in 2019, but now it's back. It's back booming. Interesting. That's Western Digital. That probably wasn't too helpful. I do apologize there, but it's really, it follows kind of the sentiment around all the or just the whole memory shortage problem. So here's ASML. This is the lithography company, the chip making manufacturer for three companies. I think they make it for like they only have three customers. It's like Samsung, Intel, and Nvidia, I think, or I don't remember exactly, or it's Taiwan Semi, I think. So ASML to expanded advanced packaging equipment market for AI chips. Cool. Anyway, let's go to their net income because they really do make a lot of money. It's quite impressive. And this is in US dollars. They are a European company, but we've converted their currency from euros to US dollars. And in USD, this is really good. I mean, record profitability quarter, specifically this quarter. They did 3.34 billion of after-tax net income this quarter. Obviously, like the whole AI chips and the AI chip manufacturers must be in demand as well. Yeah, revenue's up 18, net income's up 19, so they grew their margin. Yeah, 30% net margins for this company. That's really good. You get a 0.6% dividend. It's kind of like a surprise because they change their dividend every quarter. Like it was $3.17, then it was $1.90, $1.86. So anyway, I can see why they've done so well. They're kind of falling a little off all-time highs because everything's kind of a little off all-time highs. But I can see why this stock has done so good because they really do have great net income numbers. Record net income this quarter. So, yeah, holistic lithography solutions provider, 40 billion of annual revenue. Oh yeah, let's do APLD real quick. So APLD, actually, Nvidia just completely sold out of this stock. We can actually check the Nvidia portfolio. If you had to pick one stock to hold for stable wealth, what would it be? Or like very stable? Yeah, I'd pick like a McDonald's. Oh yeah, I wanted to get to McDonald's. Marcus told me to get to that one. Yeah, we'll definitely get to McDonald's too. I do, and that's one of my biggest holdings is McDonald's. I think my third or second largest holding. But anyway, if we go to the NVIDIA portfolio right here, they own a bunch of Intel, CoreWeave, Synopsys, and then they're like fourth largest holding used to be APLD. But if we go to sold out this quarter, NVIDIA actually sold out completely of APLD. So NVIDIA no longer owns APLD stock. But this is, I don't love this one. There's nothing proprietary about this company from a long-term horizon point of view. All they literally do is just own a bunch of NVIDIA chips. Like they literally just own a bunch of NVIDIA chips in a data center. And it's really being, and the capacity of those GPUs are being rented out to cloud computing companies. Yeah, HPC right here, data center hosting. So they're just renting out the capacity. And check out their revenue beats. This is why they gapped up on earnings day. Analysts expected 81 million. Well, they did 126 million. That was a really impressive beat. And it looks like there was some news around here. APLD guarantees 2.4 billion power plant project and receives 10% equity stake in Base Electrons. So they're doing acquisitions or something like that. That's pretty cool. Yeah, that's nice revenue growth. And if they're beating like crazy this much this quarter, what are they going to do the next couple quarters? Fortunately, they're not too profitable yet, but they're only losing, like they only lost 14 million net income this quarter. You know, that's not that much. That's not that bad. Yes, they did miss on EBITDA though by double. So it's kind of like the long-term horizon here. I don't know what the net or in-game net profitability is. Because they're the same thing as a CoreWeave, and they're the same thing as like a Nebius, where they just own a bunch of GPUs in a data center, but they'll probably do good through the rest of the decade. As like, it's more profitable and like it makes more sense to rent out GPUs, the capacity. Like Microsoft just did a huge deal with Nebius because it's so hard to buy NVIDIA chips right now and pay that 60% tax, and they just rose prices again because of the memory shortage. So it almost makes sense to rent out the capacity of chips instead of just buying a ton of them yourself and spend that CapEx today. So Nebius had a huge deal with Microsoft worth like $20 billion. Let's see what's next here. Oh yeah, let me just do McDonald's, get this one out of the way. I love McDonald's right here. A lot of people think this is like a great example of a boring, but just like a great stock. So yeah, they are my largest holding in here. They're a nice dividend payer too. We got a $33 dividend coming in. Got 18 shares. We're up 16%. So here's how I see McDonald's. This company on average will not outperform the tech-heavy S&P 500 in the long run, but what you do get is around 7 to 8% of your money back every year, and almost is like a recession-proof company that does good in a recession and when the economy is booming. Check this out. Look in 2008 when most stocks tanked. McDonald's is actually the best performing stock in the S&P 500 that year because they're recession proof. In a recession, historically, sales go up at McDonald's, and what they do is they acquire a bunch of cheap land during a recession. So McDonald's is actually a real estate and royalty company. I forgot to mention the royalties. If you go spend any amount of money at McDonald's at a franchise, 4% of that entire transaction goes back to McDonald's as literally a royalty. So this isn't a restaurant company. They receive royalties and rent from their franchises every month. Yeah, 80% of all the stores are franchised and they collect rent and royalties. That's why they have over a 30% net margin. No restaurant has a consistent 30% net margin. That's because they're not a restaurant company. They're a real estate and royalty company, seen as like a pseudo REIT. So, I don't think there's any news about them, but basically they're opening up like 60,000 new stores like planned through 2030. And all those new stores are just added basically net new royalties and rent every month. And they have customers that pay above market rents. And basically the math I see, you get 2.5% in dividends. They do 2% in buybacks a year. And then their same store sales growth, which are stores that are open for 1 year or longer, should grow at 2.5 to 3% a year. So you should get 7% of your money back for every year forever with McDonald's in my eyes. Just one of the safest, most boring companies out there. And I just trust them so much. And that's why they're one of my largest positions. It's just like a nice backbone to a portfolio. You know, you don't have it as, it's a pretty meaningful size position in my portfolio. You don't have it as like 30, 40% of your portfolio, but maybe make it as like a 5 to 10% of your portfolio or something like that as a nice defense name. And I'm actually pretty bullish on the restaurant industry. McDonald's brings the real value. I know the CEO is in some water right now. That Archburger bite. Did anyone see that? Dude, McDonald's is in heat for, but that was funny. Okay. What's your thoughts? What's up, Hudson? He said GERN. What's this company? And then I see, oh, what's up, Mamba? He said, good call on App. Yo, App Lovin'. That's my most recent purchase here in my Webull portfolio. I was looking during the software dip. I'm like, what software stock should I buy? And I concluded, I'm going to buy App Lovin'. And somehow, literally, we bought this like literally 2 weeks ago or a week ago. We're already up 30%. These are actually all my most recent purchases in order. So literally, my most recent purchase is App Lovin'. Then like a month ago, I bought AbbVie. And I also bought C.H. Robinson and Southern Company, Iron Mountain. These are all my most recent purchases in order. Like the stock I've been holding on the longest is UiPath. I've been holding the bag with this company. If you look in the bottom right, I bought this company in 2021. So we've just been, they're just too cheap to sell. But someone said GERN. I just love being fully transparent. Yeah, check this out, actually. Here's our total return in this portfolio. We're only up 7.3% all-time total return. So definitely don't listen to me. I'm not an expert. None of this is financial advice. And I don't sell anything. I have no course, book, WhatsApp. I'm just on here giving my opinion. I don't coach. Only thing I do have is a YouTube channel. So if you want to support me, hit the follow button, hit the like button. I try to stream every single day. So here's Garon or something. It's a very small company. They're only worth 980 million. So you definitely want to be careful with a market cap that tiny. And they have done terrible this past couple of years. Dang, so they're worth 950 million. And this is probably why. So they're losing a lot every quarter. When you lose 30 million at first glance, like that's not that much. But when your whole entire company is worth 900 million, losing 30 million is like 3% of your whole entire company in just one quarter. And historically, yeah, they just burn through net income. They're not even close to profitability yet. Or is the revenue growing at least? The revenue, oh wait, look at that. It went from basically nothing to something. I wonder if they did an acquisition or something. Maybe you can check out their website. I have no clue what they do. Let's see. Biotech. Oh, so they sell some sort of medical device. I'm not even going to try and pronounce that. It develops a telomerase inhibitor, imetelstat, in hematologic myeloid malignancies. So there's some English for you. So some sort of niche biotech company. Here's their website right here. I wish I could give you more thoughts on them, but yeah, I like the revenue growth. Let's see. They did miss slightly. The net income losses are supposed to narrow, which is good. Yeah, I don't know. I'd be real careful just because the market cap's so tiny. How can you support McDonald's? Yeah, what do you mean? What you mean there, FOMO? What's up, man? I see you on Rum as well. I have a small position, but I'm becoming impatient. Yeah, I almost like I now regret just like owning Rumble at all. And I own 10 shares for a reason. I literally I put $40 into this stock and this was when I bought the stock at like 10. Yeah, this was there's my buy orders. This was 12/20/23. So I've just been holding this stock for a long time. They got a $300 million donation from Tether. Like I've never seen that. They just got a donation from Tether of $300 million, but they just burned through it. This is that like free speech, like YouTube platform alternative. It really just hasn't. Yeah, like dang, the revenue's negative year over year. They just consistently lose net income year over year. It's just they don't have the fundamentals of a stock I really want to own long term, and that's why I put such a little position in them because I thought maybe they'll do something, but they never did. Oh, someone asked me a good question. Why AbbVie stock? Let me show you why I love AbbVie. This is one of the few companies I trust that have a high dividend and will give you good stock price appreciation, kind of like McDonald's. So AbbVie, even if you buy the stock right now, you get 3% of your money back no matter what, just in a qualified dividend every year. And for me, qualified dividends are tax-free. So I'm getting 3% tax-free money every year just with AbbVie. And look at the forward multiple here. So here's my thesis here. You're going to get 3% in dividends no matter what. And then I think you're also going to get on top of that 3 or 4% stock price appreciation every year on average for the rest of time. And here's my thesis behind that. They have some very growthy prescriptions like Skyrizi. Check this out. Skyrizi, it's $5 billion of revenue, a record. It's never been $5 billion before. It's up 32%, after grew 57, after grew 52, after grew 76. That is crazy. And that's just one prescription. And that's their growthiest one. It's their largest one. They also own Rinvoq. Look at that annual revenue growth. In 2019, the full year, it was $47 million. And the full year 2025, $8.3 billion. You know, this is growing. Like, look, this is why I think they're going to get 3 to 4% stock price appreciation every year because their main businesses are growing like 30, 40%. Like, what about their Botox Therapeutics? How's that one doing? It's up 13% to $1 billion for the first time. And the forward multiple is a 23 on AbbVie. They've been having some one-time adjustments to their net income because of like a thing. So don't worry about that. That's why we're looking at the forward multiple. The forward PE is a 23. So that's just my thesis behind AbbVie. It's a nice dividend payer and should get a pretty decent stock price appreciation. What do you mean qualified? Is it in a Roth? No. So basically, if a company, here's a qualified dividend versus a non-qualified dividend. If you ever heard of like a covered call ETF or a REIT, those don't pay qualified dividends. They are taxed at short-term capital gains. But like a normal company like McDonald's, AbbVie, they pay qualified dividends. So it's actually taxed at long-term capital gains tax. And for me, since I make under $48,000 a year, and if you make under $48,000 a year, no matter the state, your long-term capital gains tax is 0%. That's what's so cool. That's why taxes favor the low income if you're an investor. So also another cool thing is, and I promise you, I've done my taxes the past 2 years. I definitely know this is true. Right now, if I sold all my shares of Meta, I've owned them all for over a year. Or I should pick like Google, for example, is a better idea. I've owned my shares of Google for over a year. If I sell Google right now for a $2,500 gain, up 82%, it's completely tax-free, even in my taxable account, because it's taxed at long-term capital gains and I make under $48K a year. I think the next leg up is like a 12% tax. So that's why I'm a big fan of a taxable account and a Roth IRA. You know, that's why I'm not opposed to people just having a normal taxable account because the taxes are fair. So, so actually fun, like, look, there was my Roth IRA, even in my dividend only taxable account right here. Whenever we're about to receive this $33 in dividends from McDonald's, it'll be tax-free. So, pretty cool. Yeah, I'm in school right now. I'm in college. Okay, so Deborah, how's it going? Said TTAN stock, Service Titan. Yeah, they just IPO'd about a year ago. This is they've been following the momentum of the negative momentum of software and the positive rebound. They've actually been rebounding like more than your average software stock. They were up 6% on Friday. So let's go see what they're doing. End-to-end cloud-based software. Yeah, that's great growth. Again, they just IPO'd, so we only get like 5 quarters of year-over-year growth comp. But yeah, they beat on expectations. Check that out this quarter. Analysts expected 238 million, and they did 250 million. They were expected to lose 42 mil. They only lost 39. And EBIT too, they expected to make 14. They did 21. So it really was a triple beat quarter. So yeah, this is what you want to see. Oh, we can't zoom out anymore because they just IPO'd. But that's a fortress balance sheet too. That's actually rare for a software name to have like no debt like this. That's a fortress balance sheet. I'm actually really impressed with that. Let's see how much cash they have. They have 500 mil of cash on hand. Does it earn an interest? Yeah, that 500 mil of cash, because they have no debt, earned them 3 million of positive interest as well. So they're in a nice position where they can even do acquisitions, share buybacks, whatever they want. They can invest in the future all without having to dilute you or issue shares because they have such a nice cash position. Pretty cool. How do you get the money to invest? Oh, it's from my other YouTube channel. If you didn't know, I have a YouTube channel called Rust Moments. I don't upload it to it anymore, but that used to be my life. I've made like $100,000 off that YouTube channel. I can show y'all if you want, but youtube.com/Rust Moments gaming channel. Actually, I wonder if I can hide something real quick. I can show you the super quickly since no one cares, but I'll just show you my YouTube channel. I already have YouTube Studio pulled up. I don't even know if I'm allowed to be showing this, but yeah, here's my old YouTube channel. This was my life for literally 5 years ago. This is all I did. I've made every single one of these videos. I've edited every one, made every single thumbnail. I used to literally work my nuts off with this YouTube channel. Like this video right here made, got 400K views, and then it made 1.4K, and then all the videos make crazy. So yeah, that was my old channel. Hey, what's up, Norbero? Yeah, with the sponsorships, I made YouTube a lot more. See, that's why I own YouTube stock. I play Rust. Yeah, dude, I love Rust. Ooh, let's look at light stock. Yeah. Too many positions, it feels, yeah. That's the one thing I will say. I don't recommend the average person to have more stocks than me. Actually, I've looked at the exact bell curve of diversification. Once you get over 30 stocks, you're literally by like percentage-wise, you're not really diversifying your portfolio anymore. But just since me and my niche position, there's just so many stocks I want to own, and I really don't recommend it for the average person. But that's why I try and concentrate each portfolio. Like this portfolio right here only has 6 stocks in it. This portfolio right here only has 6 stocks in it, or 7, I mean. I try and keep them kind of simple though. But yeah, I definitely have way too many holdings for like an average person. All right. Space Ninja said PRSO will skyrocket on Monday. What's PRSO? Paraso. I've actually not heard of this stock before. Rust is a great game. Yeah, dude, I love Rust. Yeah, they were up 155% on Friday. Yo, actually, we're not really going to cover this stock. You got to be really careful with these small caps. Like if you look in the top right, they're only worth $18 million. So, and they're at an all-time low. They've done so many reverse splits that one share with the reverse splits used to cost $160,000 a share. So, yeah, these are just momentum stocks you like swing trade. Luckily, they're not losing that much money, only a couple mil a quarter. But I mean, they have $6 million of assets. Losing a couple mil a quarter. There's just some sort of momentum around this name. I don't know. But yeah, you definitely want to be super, super careful. You definitely want to swing trade that one and not just buy and hold forever. Hey, appreciate that, James. And hey, Norbero, shout out the member. Good to see you, man. If you have a stock you may look at, let me know. You are killing it. Wish I had these resources at your age. Yeah, I was just talking to my granddad. He's like, I had to pay like a $30 stock transaction fee. That was like so long ago. It was like $30 per one transaction. And just the digitalization of like investing and YouTube, like there wasn't like YouTube to tell people about investing and stuff. It's really just like the way things are now has just really helped out people get knowledge of it. Someone said ULTY. This is one of the, I thought you said Ulta Beauty. I guess, yeah, I don't really recommend these covered call ETFs. Like look at ULTY. This sells covered calls on, what does it own? Oh, it sells covered calls on all these things. Like it sells calls on MicroStrategy. So anyway, these are like a slow bleed of your capital. Like this was when it IPO'd, not even that long ago. When this IPO'd in 2024, it was $125 and now it's $32. As you can see, it kind of just slowly burned your money over time. But this is a way to maximize your income. Like, see, how can you trust this? I mean, they paid $100 in dividends. Like it doesn't do that. If it seems too good to be true, it definitely is. Like, look at the dividend yield and and that's not even the real dividend yield because the dividend goes down every year. Look at these dividend payouts that happen. So, not a big fan of these. You don't even total return outperform the S&P 500, and you pay over 1% just in expense ratio fees, which already puts you behind by 1/8 of the S&P 500's yearly returns. Ooh, Justin, what's up? He said trade desk. But, it's also appropriate for some people. Actually, I recommend if you really want to make a lot of income from selling calls, sell the calls yourself and sell it on something like, or I would try, like, especially if you're like trying to retire and have like a lot of money, like I'd recommend trying to sell calls yourself instead of it in a covered call ETF because the expense ratio fees, like it's crazy on some of them and they don't even do too well. So here's the trade desk right here. This is a CTV advertising company. I believe the CEO just like bought a bunch of shares. this isn't just a bunch. This is like a metric boatload of shares. The CEO, Jeffrey Green, buys 148 million worth of shares. Yeah, Trade Desk CEO Jeff purchases 150 million of stock, outlines 10 reasons for business confidence. Wow. He disagrees with the software is dead thesis. Well, let's go check out I don't think they reported earnings. Okay, so yeah, look at this. The day they reported earnings, they actually fell after. But the reason they gapped up 2 days ago, I guess, was because the CEO bought 150. That's a huge amount of money. So yeah, here's their net income. Unfortunately, the net income didn't grow too much. The net income only grew 2.6% year over year. Revenue's up 14. Actually, the real operating profit grew 31. So they actually did grow their margins. That was a good quarter. Like that's why like this one's still pretty decent. They are kind of being out innovated by Amazon right now. Uh-oh, sorry, my thing's kind of lagging here. There we go. Yeah, they're still making, if you average it out, like 100 mil of net income a quarter. But one thing I was reading on the bull and bear case is that Amazon is really getting directly into their space. Actually, I can pull that up right here. If, uh-oh. Okay, sorry if it lagged for a second. It says we're back, but yeah, it says we're fully back. So if it lagged for a second, that was my bad. It says we're fully back though. But yeah, I was reading what the bears say, and it says right here, Amazon's demand side platform directly targets Trade Desk's advertising space on the open internet. Like one great example is Netflix used to use the Trade Desk to find advertisers for the ads, but then Netflix actually switched to Amazon, and that was like one of their largest customers. But anyway, their numbers are still great. Look at that forward multiple. That's why the risk reward, like they're probably like they're so far off all-time highs. Like the risk reward's starting to look really good. I mean, the forward PE is only at 25, so only trading at 25 times next year's net income. That's pretty fair. You know that, but also at the same time, I think Amazon's at a 25 forward PE. And which one would I rather, for the rest of the time, if I had to trust the Trade Desk or, Amazon, maybe I'd pick Amazon. Or yeah, Amazon's at like a 27, but Amazon's like an ETF in one. But just one of their businesses is that one. Let's see. What do we wanted to look at next here? Oh, yo, what's up, Norbert? He says CMG. Yeah, Chipotle stock. This is an interesting. Or this is one of the better like restaurant stocks to buy. There's a lot of trash ones I definitely would not buy. Like sadly, like look at Wendy's. Like so, first off, Chipotle's not doing too well, but it's the whole industry that's not doing well. Like, look at Wendy's. Wendy's is lower than they were when they IPO'd in 1997. Like, if you go to Jack in the Box right here, Jack in the Box is lower than they were in 1999. I mean, these restaurant stocks and like Krispy Kreme, DNUT, Krispy Kreme is at an all-time low. But Chipotle is one of my favorite restaurants if I had to buy one. McDonald's is my favorite, but Chipotle, they print net income. If you scroll down here to their real after-tax net income, they really do make over 300 to 400 mil a quarter, but they're experiencing that margin collapse right now. Like, so the revenue's starting to slow. Like this quarter, the revenue grew 4.8. So the revenue's up 4.8, but the net income actually fell 0.25%. So that means the net margins are going down a little bit, like food costs and stuff. So their net margin fell 5%. So we are watching their margin number. We like gross margins are down 5, net margins are down 5. So we definitely want to see that improve, but it's not just their fault. So this is one of the best ones I think to buy on the rebound. Unfortunately, they're not too cheap yet. Like if you go to the forward multiple here, I think it's like a 31 or what are they at? A 31 forward PE. That's weird. The current PE and the forward PE are the exact same. So that means they're not experiencing or not expecting any EPS growth. Yeah. Dang, the EPS is going to be nearly identical to what it was the same time last year. So let's see if we can get an earnings recap. Yeah, here's their number of stores. They have 4.04 thousand stores, up from 3.73K thousand. So that should just like grow the earnings. So let's see. Revenue growth of 5% was mainly driven by new restaurant openings, though comp sales declined 2.5%, ongoing traffic challenges. So that's bad. Operating margin declined and restaurant level margin fell, reflecting inflationary pressures on ingredients and labor cost, not fully offset by pricing. Again, that's like every restaurant right now. I feel bad for a lot of these restaurants, but this is one of the best ones to buy. Hopefully that was kind of helpful here. 31 forward PE, that means I would not go crazy buying the stock yet. Like if I wanted to significantly own them, I would not make them a meaningful size position at today's valuation. I think they might be able to go a little bit cheaper, but they're one of the better ones to buy over like all these ones like Jack in the Box. Like look at Wendy's, RIP Wendy's. Okay. Ooh, I'm seeing some good ones here. And sorry if I'm a little bit behind here. What about technical analysis? Like, you don't use it? Yeah, that's the thing. I mainly judge the fundamentals because when you do technical analysis, it's really just judging what they're going to do short term and maybe like slightly medium term. But I judge a company off the thing that actually moves the stock in the long run, and that's the financials. Um, how many do you at least have for stock? The number of stocks you own? Oh, I probably own like 45 stocks, which is way too many. I noticed people are asking about a good dividend. PFE is a favorite of mine. Yeah, this one's kind of one you buy to another one you buy to maximize your income. Because again, you shouldn't get too much stock price appreciation, but I do like some of their bullish catalysts right now, like their acquisition of Metsera, which puts them at over a 5% market share for like weight loss prescriptions. But yeah, Pfizer stock is the same price that it was in 1998. So the stock has not appreciated too much. But what you do get is a nice qualified 6.4% dividend yield. Not too shabby. And the dividend is safe, and we'll actually go verify the dividend is safe. But check this out. Pfizer's GLP-1 weight loss prescription receives approval in China. So that's great news. Clinical trials demonstrated 15% weight reduction in over 92% of the patients. They actually acquired this company. Anyway, that's why I think it's a nice tailwind, that Metsera acquisition. That's what I actually really like about Pfizer. And look at that forward multiple. It's only a 12. So they're trading at 12 times next year's net income. Did they have a one-time adjustment? Okay, this is probably from the acquisition, but look at this. It says they lost $1.64 billion. Here's how we can tell it was a one-time adjustment, because the core operating profit grew 15%. It was $3.6 billion. But so they had a one-time adjustment. So anyway, let's look at the other quarter. They usually make, actually, if you average it out, they usually make right around over $3 billion in net income a quarter. Let's go see how much the dividend costs. So the dividend cost exactly $2.45 billion. So as long as they're making over $2.45 billion a quarter, they can afford their 6% dividend. And here's their EBIT right here. Yeah, look at how they've been beating on EBIT the past 3 quarters in a row, very massively. So they're another one of the probably better, higher yielding plays. So let me pull up LITE, and then we'll do CNQ and VST. I definitely want to get to these. My apologies if I'm missing them. So I believe this company got added into the S&P 500. Was that the news? Yeah, Lumentum Holdings to join S&P 500 index, and NVIDIA actually commits multi-year components purchase agreement from Lumentum and buys their own stock. So NVIDIA is literally buying Lumentum stock to secure optical component parts. Pretty smart by NVIDIA. The whole company's worth $39 billion. Let's see that. Yeah, so they sell components. Check out the future expectations. There's going to be nearly 100% revenue growth. The revenue is going from 480 to 916 million. And same with the profits too. The EBIT's going from 72 to 287. So no wonder this stock, before today has been doing so well. It's not just some weird momentum. It's real fundamentals that are going up and real future expectations that are great. The guidance is so good. And look at his net income. Like it was a tough buy. Like who's buying the stock that loses 100, 250 mil a quarter? It's a tough buy. But now we're in an environment where the net income expectations are they're going to be making like 200 mil in net income a quarter. That's why they've had such a dramatic increase in stock price, because of the such sudden change in expectations. That's how you get a multi-bagger of a stock. Now, I don't know if I'd buy the stock today. What's the valuation? So a 50 forward PE, but it's certainly a nice decline from its current PE. So if you look on the left, like extremely expensive, 161 times earnings, but the forward PE is only a 50. So they're literally going to 3x their earnings. And then you really do like a 2 or 3 year out forward multiple. Light is a hot one right now. Yeah, especially with their S&P 500 occlusion. So now that they're in the S&P 500, lots of money is just going to passively flow in them, these S&P 500 copy ETFs and stuff. And I believe this company, was it Vistra Energy or maybe it was a different one, but they also just got added into the S&P. Oh, that was Vertiv. I'm thinking of Vertiv, VRT, just got added into the S&P 500. We'll look at O'Reilly stock. Yeah, they do heck of buybacks. And Wingstop, I really like Wingstop. Wingstop is like copying Robinhood's successful business model. I asked, would you buy only one stock or more at a time? I usually just buy like one stock at a time. Yeah. All right. Because I don't do major changes to my portfolio. So yeah, and I'm probably misunderstanding that question, and I apologize. But here's Vistra Energy. This is a PJM. They're kind of like a Constellation Energy. They're the second best nuclear company Constellation Energy owns like 34 reactors. Vistra Energy owns like 4 nuclear reactors, but that's still the second best. Let's see. Vistra Energy completes Lotus Infrastructure acquisition for 1.9 billion. That's great news. So they're buying a company for 2 billion. Announces Congentrix Energy acquisition agreement, adding 8.1 gigawatt capacity. So that's good news. The forward PE, I'm pretty sure, is really good. Yeah, look at that. The forward PE is only a 17. So they're only trading at 17 times next year's PE. So yeah, they're an unregulated utility that mainly in the PJM. It's like these 13 states, these electricity auctions called the PJM. That's where they mainly serve, and that's been the growthiest right now. So anyway, you really just focus on the forward PE because they're kind of like Constellation Energy, where the number they have these one-time adjustments because their utilities investing so much back into the business. So yeah, and you get a nice yield of 0.5% yield. Now look at that payout ratio. Only a 12% payout ratio. Very fair. Lots of room for them to raise their dividend. Very safe forward PE. Not too shabby. Yeah, let's do O'Reilly Auto Parts. So this one, I guess for the guy asking for technical analysis, this brokerage sometimes does some technical analysis for me. I guess what is this right here? There's a bullish continuation wedge, and I guess they're saying the rise probability is at 94%. So that's not too bad. Wow, they've done, look at that. Like, here's the thesis behind O'Reilly. Like, in a recession, people put off buying a new car and spend more money repairing their old car. So, and that might be the environment we're in right now. And this company doesn't pay a dividend. So here's the thing. O'Reilly makes easily 600 plus million of after-tax net income a quarter, and they don't pay a dividend. So what is O'Reilly doing with all that net income? Well, check this out. At the top here, this is the number they're spending every quarter on buybacks. Literally every single quarter, no matter what. They almost spend basically 80% of what they're making on solely buying back their own stock. And if they spent all this money on dividends instead, you get like a 3 to 5% dividend yield every year. And they've been doing that for all of history. Like, look, like not way back ago, but like 2021, they were always buying back like 500, 900 million of their own stock. And it's so accretive to right now stock and EPS. Just gives you more ownership in the company. So yeah, I have no complaints about this company, except they might be a little expensive at a 29 forward PE, but it's just such a shareholder-friendly company, and the buybacks just send the stock up even more. I specifically look for companies that do massive share buybacks, and O'Reilly is one that does them great. So I actually want to show you their total common shares outstanding go down over time, just to get that kind of visualized for you. And we'll look at the next stock. And yo, thank you so much, Craig. Yo, shout out to Craig on the YouTube stream, bro. He just left a $5 super chat. Dude, I really appreciate you, man. If you have a stock you want me to look at, let me know. You just made my day. I really appreciate that, Craig. But yeah, check out their total common shares outstanding. Or actually, they did a stock split. No, so it's going to look weird. But anyway, look at 2019. So in 2019, on the very right, there were 75 million shares. And look at these year-over-year comps at the bottom. It's always going down like 5%, 6%. That's the year-over-year comp. So the shares outstanding went from 75 million to 58 million. Like just in 2024 to 2019. So they bought back like 20% of all the shares. And then they did a stock split, which doesn't dilute you. Don't worry about the stock split. That does nothing. It doesn't do anything for the buybacks. It's still, I don't even know why I'm mentioning that. So don't worry about that. But anyway, they buy back 3% of all the shares a year. It's crazy good. Dude, thanks so much, Craig. Let me know. Oh, AMPX. Yeah, that's that battery stock. Let me quickly, I'm trying to understand how you break down fundamentals. You go so fast. Yo, my bad, Power. Yeah. By the way, I'm also streaming on YouTube. So if you miss anything, you can like slow it down and watch it on the replay. Yeah, that's not bad. That's the best way to support me. If you guys want to help me out, just hit the like button or subscribe to my YouTube channel. I'm trying to build it up. I try and stream every day and I sell nothing. I have no course, book, WhatsApp, Discord, or Telegram, or I don't coach or anything. Just on here giving my opinion. So here's Wingstop. Oh, and then CNQ. We'll look at CNQ after this. My bad there, Mason. So here's Wingstop. This is another one that collects royalties from their franchise locations, just like McDonald's does. So if we go to the revenue breakdown, or it used to break, oops, it didn't load it. Wait. How far do we have to go back before it breaks it down? So yeah, basically look at this. 50 or half their revenue comes from their royalty revenue, basically their franchise fees. So if you go spend like $100 or any amount of money at a Wingstop, like 4 or 5% of that goes back to this parent company as a royalty. But then a lot of their stores, like 20% of their total revenue is from their company-owned restaurants. Check out the revenue expectations. It's going to go to 200 mil. I wonder if there's any earnings review. No, there's not. But yeah, they do make good net income every quarter easily. Well, let's remove the one-time adjustment. Like this is basically their net income, excluding that adjustment that they had. It grows very nicely. Like this is what you want to see for a growth stock. Unfortunately, I think they are a little expensive, or well, I don't know. Yeah, so look at that, a 49 forward PE. So it is expensive at current prices, unfortunately. So that might be the bad part. Like even though the stock is already down like 50% from its peak, it might still be a little expensive even on the dip. Dang, why are the forecasts bad? I mean, oh, it's not. So the net income, they beat like crazy on net income every quarter. So maybe the forward PE is even cheaper if they beat 20, 30% like they do normally every quarter. Where are you streaming from? I'm from the USA, man. What's up? I'm a new subscriber. Are you live on Twitch? No, I am only live on YouTube and TikTok, but I appreciate you. Thanks for subscribing. I do appreciate that. And the stream will stay up forever on YouTube. So CNQ, is that the Canadian Natural Resources? Wow, they are at an all-time high, kind of like most energy stocks right now. You look at like an Exxon Mobil, a Chevron, they're also at an all-time high right now. So let's see. Yeah, the forward PE is a 23. So oil sands mining and upgrading and exploration and production. So, but yeah, an oil, gas, energy play. They beat good this quarter on revenue. They expected 9.3. They did 9.6. Let's actually convert the currency. So this is a Canadian company, hence Canadian Natural Resource. But we'll convert the currency to US dollars to get a better idea here. Here's their net income. It looks a little choppy, but if you average it out, they really are making like in US dollars, like close to $1 billion of net income every quarter. You get a 3.6% dividend and a 75% payout ratio. Maybe it's a little lower. But with the past couple of weeks, I think why they've gone up is because of all the Iran war shenanigans. It's sending ExxonMobil to an all-time high. If you've filled up your tank the past week, you probably know what I'm talking about. The oil prices have been going nuts, and that should only help out Canadian Natural Resources margins. So anyway, it's tough to buy this one, certainly at an all-time high, because a lot of people are expecting like oil prices to kind of calm down. But it's a nice dividend oil stock, 3.6% yield. Seems like a safe payout ratio. Like basically Canadian like ExxonMobil, Oh, Taiwan Semi and Heiko. Let me do Heiko. I think Warren Buffett just bought more of this stock this quarter. Oh, and then AMPX. I completely missed that one. My bad, Craig. Yeah, AMPX is next for sure. And then we'll do Taiwan Semiconductor and some of these other names. What's up? And Allstate. So here's Heiko right here. This might be an insurance company, or I might just be wrong here. Flight Support Group. Okay, so Flight Support Group. That's growing very nicely, though. It's growing double digits. It's up 20% year over year. After grew 15, after grew 74. So they're actually on a nice streak of growth for their Flight Support Group revenue. And they're also in Electronic Technologies Group. That's up double digits, 14% year over year as well. So that's interesting. Yeah. So they beat on net income for the past 3 quarters in a row, and net income projections are expected to just continue to climb higher. Yeah. Here's net income right here. Looks great. That's what you want to see for a growth stock. Net income's up 12% year over year. Revenue's up 14. You get a very low dividend yield, but look at the payout ratio. It's only a 5% payout ratio for like a 0.1% dividend. It says they're in aerospace and defense. Flight Support Group, electronic. So it's Flight Support Group segment designs, manufactures, repairs, and overhauls, and distribute jet engines and aircraft components, replacement parts. So that aerospace and defense kind of play maybe. Interesting there. I like that they have a super low dividend payout ratio there. Got in on the April low. Thanks for reviewing. Yeah, hey, no problem there, Mason. Yeah, nice buy there, and you get a good dividend. This is and let me do AMPX, and we'll do Taiwan Semiconductor. I have a lot of good news about Taiwan Semiconductor. So AMPX, this is apparently like a drone battery company. I can see why the momentum has been so positive. Like this stock is at all-time high, not because of momentum solely, but because of their good financials and what they've been reporting. Like if we go to revenue right here, for the past 3 quarters in a row, they're beating on their revenue expectations. They're basically transitioning from a company that had like no revenue. Like a year ago, they were doing like $2 million in revenue a quarter. It's a tough stock to buy. But now it's like at a scenario where it's just hitting a new record every year, every quarter, like ever since then, where they're doing 20 million in revenue this quarter, which is 80 million annualized. And then what if they do next quarter 30 million? That'll be 120 million annualized. And it just, at this triple digit growth rate, it's like we're so curious on what is the numbers going to be these next couple quarters. And they're really significantly narrowing their losses. They're basically losing no money anymore. They only lost $3 million this quarter. And they diluted every shareholder by a lot of money, but they have no net debt anymore. They have like 50 million in net cash, which they're almost going to get net income positive soon. So, yeah, sale of battery products. Apparently, they're selling in drones right now. The U.S. is only 34% of revenue, but yeah, I can see why they've done so well. Empress defense contract highlights NDAA shift in silicone battery adoption. So they got a defense contract. Oh yeah, probably from drones or something like that. So Taiwan Semiconductor, this is one of my favorite AI fab names, it is my favorite AI fab name. So if you didn't know, NVIDIA just designs the chips when Taiwan Semiconductor actually manufactures them. So let's see, NVIDIA invest $4 billion in Lumentum and Coherent. Yeah, we know that. So if I was a shareholder of Taiwan Semiconductor and I've seen it go up so much, I would not be selling or trimming a single share because I think this company is almost definitely going to go back to all-time highs maybe pretty soon. Because if you look at the forward PE, like this is why I think Taiwan Semiconductor is a really good company. The forward PE is only a 24. I really feel like this could stretch up to like a 28, 29 forward PE before it really maxes out, and that sends this company up like 35%. So they have the number one market share. They literally have what's their market share right here? A 71% market share, and all the expectations are up and to the right. They beat on net income every quarter. You know, they expected 15, they did 7, or they did 16. But look at their margins. The total revenue is $33 billion. On this $33 billion of revenue, they netted $16 billion, which means they have a 48% net margin. So if you go spend $100 on one of their chips, they literally keep after tax $48. It's insane. And their biggest customer is NVIDIA. Their second biggest customer is Apple, because Apple also, they make, Taiwan Semiconductor makes Apple's smartphone chips, and they make NVIDIA's GPUs and everything. And they're moving some of their fabs to like Arizona, like they're investing in the US now with these Arizona Phoenix fabrication sites. So anyway, I really like Taiwan Semi. I'm trying to get into trading, but I have no clue where to learn or start. Hey, what's up, man? I wish I could help you out there. But, you know, I always just recommend, you know, have the backbone of your portfolio in the S&P 500. You know, this S&P 500, the average retail investor and hedge fund just cannot outperform the S&P. So own this as like the good backbone of your portfolio. Then I buy some individual stocks that you know and love. Like if you like and use Google and Meta, you know, buy their own, like in McDonald's, you know, buy their stock, you know, because they're good S&P 500 companies like Google with YouTube and AI, Meta Ray-Bans, Facebook, Instagram, Threads. So I own Amazon. I got an Amazon Prime subscription. Why not own some Amazon, the number one company by revenue in the world? Can we look at Allstate? Yeah, let's do Allstate. That's an insurance company. Oh, and I see QQQI. I think that's another covered call ETF. So wait, ALL. Let me know if you're talking about Allstate or Aristocrat Leisure, because I'm pretty sure you're almost definitely talking about Allstate. You know, I'll just go over Allstate. Isn't this like the car insurance company? So, wow, the stock has done phenomenal, you know, easily at an all-time high right now. Let's see. So Allstate Protection. So how's that growing? Yeah, it's the growth is slowing down a little bit, but it is still positive growth. You get a nice, even though the stock is at an all-time high. Is that real? Whoa. Look at that. So they basically have a 2% dividend. That's crazy. A near 2% dividend, and the payout ratio is only a 10%. So they're paying out 10% of earnings for a 2% yield. That's because the multiple is so cheap. They literally trade at 5.5 times net income, or 8.5 times next year's net income. But that 5.5 net income multiple, that's crazy. And they've been beating, look at that. They expected 2.5 bill. They did 3.8. They've beat like crazy these past couple quarters on net income. That's really impressive. So, but I guess they're expecting the net income to fall a little bit. That's why the forward PE is lower than their current PE. But anyway, is there any Morningstar research on them? Allstate has historically had a differentiated approach through its captive agents and bundling strategy, increasing price on many of its policies, which should lead to improvement, benefit from higher interest rates. So it's an interest rate sensitive play or something like that. Anyway, yeah, they're at like a 5.5 PE. That seems like very cheap. Oh, what's up, Flesito? He said Rubrik. Let me do Rubrik right here. This is actually a cybersecurity software name. I'm really bullish on cybersecurity specifically because as AI improves, like hackers will only get better at hacking because of AI. They can utilize it. So I'm just a big believer on cybersecurity. And if we go to this company, they have some extremely impressive growth. They IPO'd like 2 years ago, but the revenue year over year is up 48%. Like on the bottom year over year growth rates, like 48% this quarter, 51% last quarter, 48, 47. And they also just did an acquisition, which is one of the other reasons why they're kind of growing really fast these past 2 quarters, because last quarter they bought a company for $800 million. But I really like this top line growth, and they're narrowing their net income losses, which is great. Because one bad thing is they used to lose like 100 to 200 mil a quarter, but now like they only lost 63 million this quarter. That was huge because analysts expected them to lose 123. Them only losing 63 is great. And last quarter as well, they expected to lose 145. They only lost 95. And look at the EBIT. Actually, this was probably the most impressive part. They're expected to lose 42 million of EBIT. You know, can't adjust these numbers, but they actually made 10 million of earnings before interest and taxes. And they beat on revenue. So anyway, Rubrik is an interesting niche growth stock. I'd put on the watch list. Yeah, no problem there, Craig. Let me know if you have another stock you want me to look at. I'll definitely check it out. So here's Coinbase. This has kind of been a crypto proxy. So there's the price of Bitcoin over Coinbase. As you can see, it's not perfect, but you know, they definitely like rhyme together. You know what I mean? Especially the more we zoom in. So yeah, Coinbase is kind of like a Bitcoin proxy. But what I like that Coinbase just did is Coinbase is actually launching, they launched a stock trading feature with 24-hour trading, and they're adding in prediction markets to the app. So I'm having my own prediction is that Coinbase, like historically, they always follow Bitcoin, like right here. It almost looks identical, Coinbase and Bitcoin. I think they're actually going to decouple from Bitcoin and do even better than Bitcoin does, like Robinhood used to when they first introduced prediction markets. So they're actually going to be making a lot more profitable revenue from the prediction markets and stock trading. So that'll be like an additional source of revenue. So they're just, they don't want to be out innovated. Here's kind of a cool metric. This is their monthly transacting users. So not just monthly users, but monthly transacting users are at 9.2 million. So not too bad. And what's the forward PE here? That's a good question. Even though I know they just mainly follow Bitcoin, but the forward PE is a 48, so it's not cheap, but kind of don't look at the net income multiple. But anyway, hopefully that was kind of helpful there. I do like what they're doing. Oh, William says Rubrik reports earnings next week. Hey, I'll definitely be watching that. That'll be interesting. QQQI. That one mainly, so this is basically it's an alternative to JEPQ. So JEPQ, QQQI, these just sell covered calls on the NASDAQ. So it owns the same things as the NASDAQ does and then sells calls on them and they just pay you what their distributions. They're not dividends, it's like a distribution. So you get a monthly dividend with this company. So you buy that to maximize your income. What should we look at next? Thank you. I'm starting to small. What I can risk losing. That's definitely what you should do. Don't invest what you can't lose. Like don't invest next month's rent or something. Right? Yeah, dude, your future self will thank you just for investing. You know, the goal isn't to get rich quick. It's kind of like boring. You know, the goal is to get 10% of your money back a year. You turn $100 into 110 in 1 year, but then you snowball CAGR at 10%. And it is, as you invest more money and reinvest the dividends, you get that snowball effect where it starts from 100 in 1 year to 110, and then it goes from 110 to like 140, and then 100. You kind of get the snowball effect there. But someone said Palantir, and then we'll do, hey, Marcus, give me the ticker symbol for HK Foods. Yeah, if you give me the ticker symbol, we'll check it out. And then we'll do Red Cat. Yeah. So, what's up, Sanchez? He says Palantir. We'll do this one real quick. Oh, and I see Wolf, and I own NVIDIA, ASML, and Taiwan Semi. Very happy with him. Yeah, those three have been great. Taiwan Semi, I'm jealous of because I do want to own that stock eventually. But here's Palantir. They're actually seen as a key beneficiary from the Iran stuff. So look at this. Palantir cited as beneficiary of Middle East conflict as U.S. defense AI demand surges. Palantir wins up to $1 billion U.S. Homeland Security software contract. Pretty insane. But check this out down here. A lot of the revenue comes from the government, like a lot of police stations, the Air Force, the military all use them. The government revenue's up, 60% year over year. After grew 40, after grew 10. So literally the growth rate is growing on this business, up 60% year over year. Then they also have their commercial side, which is with other S&P 500 companies like Google and GE Aerospace. That's up 82%. After grew 30, after grew 31. So this growth rate is growing as well. Like I can't stress how impressive 82% year over year growth is. And no analysts were expecting that, especially on net income. Look at this. They expected 460. They did 608 mil of after-tax net income with a 43% net margin. That's getting to like some Nvidia type margins. That's nuts. And a huge another cherry on top is Palantir has no debt, literally a debt-free fortress of a balance sheet and like a ton of cash. Yes, over $7 billion of cash because yeah, they have no debt to pay or dividends to pay. So anytime they make like they made $600 million net income this quarter, $700 million of free cash flow. Whenever they make that, it just goes to their cash pile because they don't owe anyone any money. They can just retain it and then do share buybacks. Hey, thanks, Luffy. Yeah, dude, I really like that video on Moog. That's my most recent stock. Here, I'll show you that really quickly. My most recent purchase, if anyone's wondering, is ticker symbol MOG.A. I bought them literally yesterday on Friday. We're up 1.6% on them. Not too shabby. We bought all of our shares yesterday. I sold Cavco to do it, and I deposited like $600, but I sold Cavco to raise the funds to buy MOG, or they're called Moog. It's my new favorite, like aerospace and defense stock with the nice data center tailwind. If you want to see more on Moog, check out my most recent YouTube video. I did an insane deep dive on it. I think it's one of the best videos I've like made. So I appreciate that. Okay, what I want to look at next? Oh, Wolf. I think this is one of the Bitcoin mining companies. They were just like saved from bankruptcy a while back. Let's see if there's any news. TeraWolf reports 168 million in revenue and 12.8 billion long-term, high performance computing contracts. So let's see. So 150 million from digital asset mining and 6.8. Okay, so look, here's the thing. Almost all this company's revenue is still Bitcoin mining revenue. Yeah, okay, well, here's it broken down. So for the full year 2025, 90% of this company's revenue was their Bitcoin mining revenue. Again, I don't like the long-term outlooks of these stocks. Like, they'll probably do good through the end of the decade, but the long-term horizon isn't good on these stocks. All this company does is own data centers in it, or is own a bunch of GPUs in the data center. That's literally it. And right now, their GPUs are mining a bunch of Bitcoin. But right now, what's really popular is AI is taking off and the price of chips are really expensive. So they're actually getting asked right now, hey, can we rent out the capacity of your chips for our cloud and our high performance computing? So they're actually leasing out basically the capacity of their GPUs. I just don't love the long-term business model. And look at these net income losses and the leverage. I mean, dang, they lost 455 mil last quarter, 120 mil. Like, if we zoom out, like they just don't make money. So I just, like, the stock has had some good momentum and stuff. I know they had like a Google partnership or something, but it's just not, I don't feel too comfortable with the long-term thesis. It could be a great little swing trade or something. Yeah, they invested $1 billion this quarter into something. Interesting. The Bank of Nova Scotia owns a lot of shares here. Anyway, that probably wasn't too bullish, so I apologize, but yeah. HK Foods. You know, I'll type it in for you. I really would prefer a ticker symbol. Yeah, HK Foods. All right, I typed in HK Food. Is this it? You said it's in Finland. Oh, wait, HKFOOH, you said. Oh, my bad. Or I typed in HKFOOH or HK4. Unfortunately, I typed in all those names and it's just not available on my brokerage. So I just can't view Finland stocks markets. Or I tried my best, but unfortunately, if you have another stock you can look at, let me know though. We'll check it out. Well, oh, hey, Catherine said RCAT. This is a drone play. This is actually one of the best drone plays out there. They have this Black Widow drone, and the Black Widow drone has NATO approval, and they're selling it to all the other NATO members right now and the US. Let's see. So Red Cat Holdings partners with Allen Control Systems to integrate Bullfrog counter-drone technology into autonomous defense systems. So they also have like this drone defense system. Red Cat Holdings gains as defense and drone stocks rally on escalating Middle East tensions. Okay, let's go look at the fundamentals here because they're basically getting their first ever set of real orders. Like if we zoom out, like this was the highest revenue ever. It was 9 million of revenue, which still isn't even that much. So they did 9 million of revenue, again, record revenue, but check out what analysts are expecting. The reason the stock has done so well is because of future expectations. Next quarter, and we definitely don't want to see them miss, but analysts are expecting them to do 24 million of revenue. Again, 9 million was a record this quarter. They're expecting 24 million and then 24 million the quarter after. So if we annualize that, that's basically 100 million of revenue a year. So the company's converting from a company that's doing a couple mil a quarter to 100 million of annual revenue potentially. So I think it's just really pricing in that future growth, and they've fortified the balance sheet by issuing shares. So if we go to their cash and financing activities, again, just with the past 2 quarters, they've kind of diluted you by $300 million, but look how that fortified their balance sheet. They have no debt at all and over $206 million of cash. So they can easily afford to lose, like if you go to their net income, they're losing like 20 mil a quarter, 10, 20 mil a quarter. So they can easily afford to lose money for the next couple of years and quarters with that huge cash pile. Anyway, I'd still be careful with this one. I probably wouldn't allocate to this one at current prices, but it's a interesting drone play that does have some real drone assets. Like there's a lot of speculative drone plays. That's one of the better drone plays for sure. Have you looked at UiPath? Hey, I've not looked at UiPath yet. But I want to get to let me get to AEVA, and then we'll look at Ontario Midstream, and UiPath. Yeah, I'm down bad on UiPath. It's like the first ever stock I bought. or it's certainly the oldest stock I bought that I still own. I bought them in 9/2021. Okay, come on, AEVA. Doesn't want to load, even though I'm typing AEVA. Oh, there it is. Ava Technologies. Sorry, we're back. So unfortunately, this one has not done too well, but there does seem to be some momentum happening. Like there was a huge volume spike this day specifically, and they gapped up. So I wonder what that news was. It's not showing up down there. So they're a LiDAR stock right here. Okay, let's go check out the revenue here. So non-recurring engineering service. So that was only 1 million in revenue, and product revenue was 1.7 mil. So when we combine the two businesses, the total revenue, so it's still so they're a very small company. The revenue was, 3 million, 5 million, 3 million. Ooh, and it's not the best balance sheet. Like last quarter, they had a lot of liabilities. I'm assuming, they had to dilute to kind of fix that issue. They lose 30 million a quarter, and what are they wholly worth? So that's why the stock has done so bad. Here's kind of, if you think about this logically, the whole company's worth 850 million. So you could buy this whole company for $850 million. Let's say you do it. You buy an asset that loses you over 30 million a quarter, or 120 million of net income a year, which is well over 15% of your entire market cap and company a year. But it is following kind of the positive momentum around the LiDAR. I've actually done no research on this one. I remember the other LiDAR stock I really, really like. Oh, I forgot what is Ouster. I really like Ouster as like the best, most quality like one, which I think is also on a dip right now. So but let's see, EVA Atlas for automotive grade 4D LiDAR. So LiDAR is really popular now because of these self-driving cars. Self-driving cars use not robotaxis, but like Google's Waymo uses LiDAR in their cars, and it's just really popular right now. Ontario Midstream. So, Matt, we looked at Taiwan Semiconductor like 5-10 minutes ago. I think when you first asked it. By the way, I'm also streaming on YouTube. You are able to rewind. But yeah, if you skip like 10-20 minutes ago in the stream, I think you'll find my Taiwan Semi analysis. My YouTube channel is called Nathan Roberts. It's also in the link tree in my bio. You can just type in YouTube Nathan Roberts. So this is an oil and gas stock, and they're a midstream company, so they own like a bunch of pipelines. And obviously, they've done great the past couple quarters. You don't really zoom out too much because this is like a dividend play. What's the dividend here? Dividend. Yeah, look at that. You get a 4% dividend. So 4% in dividends and nice stock price appreciation, or at least for the past year. But when we zoom out, oil doesn't historically like crazy outperform, the S&P 500, but it does give you the nice dividend. And for times like this, when oil's spiking, you can capture that gain. So they're at a 20 forward PE. That's good compared to their 26 PE. Gathering and processing, and they're also in water handling. That's interesting, which did fall a little bit year over year, but gathering and processing, that's growing very nicely. A lot of oil and gas stocks are actually like negative. Like if you're looking at Exxon, Chevron, EOG, they all have like -10, -5% year over year revenue growth, but this one's actually positive. So I can see why specifically just the past 2 years, they've been outperforming the average oil and gas stock. Yeah, look at that margin. So they did 300 mil of revenue, and on that, they kept basically 130 mil. They had a little one-time adjustment this quarter, so the net income was slightly higher. But anyway, some sort of oil and gas stock. I don't know if they give a K1 tax form. That's one thing you definitely want to look at. Do you ever buy a non-profitable stock? Yeah, sometimes. Usually I try not to buy like money-losing companies, but I'm looking on this list here. I don't think any of these, well, besides like Rumble or something, but like no, now that I think about it, I don't think I own any company that like loses net income. Like I'm really trying to think. Oh, Webull, but not really. Webull's now net income positive. Yeah, I don't think I own any stocks that really really lose net income. Yeah, no. because I usually buy stocks that make a boatload of money, and the kind of stocks I share with shareholders via dividends, share buybacks, doing M&A. So uh yeah, my bad there, Matt. But if you have another stock you may look at, I can definitely check it out for you. Eva just partnered with Nvidia as their top choice for LiDAR. Oh, really? So that's probably great news. Speaking of this stock we just looked at, AEVA, they had an Nvidia um, partnership there. Nvidia chooses them. What should we look at next here? Um, Prentice said AR stock. What is AR? Oh, Ontario Resources. Is this like the parent company? Because we just looked at like the midstream company. This is Ontario Resources, which is the exploration and production. The other company owns the pipelines, I believe. And yeah, the revenue's up 20, net income's great. So yeah, this one's done really good, or at least the financials are. Again, if we kind of zoom out, the stock, kind of like the other one, is kind of the same price that it was in 2015. But what's the yield here? Oh, this one actually doesn't pay a dividend. Really? I didn't know that was the parent company's stock. So CoreWeave, yeah, what's up, 1.5? Yeah, CoreWeave, that's a big holding from NVIDIA. If we go to the NVIDIA portfolio right here, CoreWeave is 21% of their portfolio. You know, they own a lot of Intel, Synopsys. So basically, NVIDIA has a huge stake in them because CoreWeave just buys a boatload of NVIDIA chips. And right now, they're actually like, they're crushing all their competitors and getting revenue growth, but not profitable revenue growth, because they're literally undercutting the cost of all their competitors. They're like the cheapest person to go to if you want to rent out GPUs, because they're basically taking out debt to buy a bunch of NVIDIA chips and then just undercut the cost for everyone. CoreWeave to deploy NVIDIA's Rubin GPU platform in second half. CoreWeave signs multi-year strategic partnership with Perplexity. That's great. I think they have a huge backlog. Let me actually see if we can get our earnings recap on this company. So yeah, look at the third line here. Number 3, the revenue backlog expanded to $66 billion. That provides strong future cash flow visibility, while capital expenditures are expected to more than double next year. So yeah, they're not too profitable. Like if you go to net income right here, check this out. See, the past couple quarters, this is the one thing I don't like, is the net margin game here. Like they're losing a couple $100 million a quarter. Like, yeah, they have great top line growth. Like, look at this revenue growth. The revenue's up triple digits for the past 5 quarters in a row, and the revenue expectations are even higher. Like, look at this. The revenue is going to go from 1.2 to 2.7 billion. So the revenue is going to more than double. But look at the losses. The losses are going to double. Shouldn't it be, as the revenue grows, the net income losses should narrow? But as the revenue's doubling, the losses are doubling. It's because of their business model, and that's a little concerning to me. Like, look, net income's going to go from negative 290 to negative 566 million. So yeah, it's the very great revenue growth. It's just kind of the overall thesis here. I don't know what the net margin end game here for this company is. Again, nothing proprietary. I'd rather be in NVIDIA's position. I'd rather be NVIDIA, where CoreWeave is just boatload buying your chips like crazy for a 66% net margin. That was kind of bearish, though. I think they'll probably still do good through the end of the decade, but like, I don't love the super long-term thesis around them, because it's literally just, they just own a bunch of NVIDIA chips. Chemex, thinking I should sell, up 50% in AAL. Oh, American Airlines. Yeah, the airline stocks. Let's see. U.S. airline face fuel cost surge as jet fuel prices jump to $150 per barrel. So yeah, fuel costs are huge expenses for airlines. U.S. Transportation Department approves American Airlines Miami, Venezuela route. American Airlines suspends Philadelphia flights through March 1st amid Middle East airspace closures. Anyway, I will say I'm not a fan of airlines in the long run, because historically, and it's not just American Airlines, it's almost every airline in existence. Yeah, every airline that exists, none of them even come close to keeping up with the S&P 500. Like, if you're trying to beat the S&P 500, I am not a fan of owning airlines or cruise lines, highly federally regulated. They get smoked in a recession, very cyclical, but they have started to improve. Like, well, see, like the net income is so choppy here. Like, look, like they make money, then they lose money. And it's kind of like just been that for all of time, especially if you go back to 2021, 2022, like the COVID crash really crushed them. They were losing over $2 billion in net income a quarter, had to get saved by the government, very leveraged, more liabilities than assets. So it's just not the kind of company that I think will outperform the S&P 500 if you buy it, but it's something you like swing trade because it is sort of like goes up and down and has these big swings. It's like a travel play, spending play. But yeah, I'm not too bullish on the super long-term outlook on just buying and holding that and never selling. So what do you think of HL? What is HL? Helka Mining. Is this a gold stock? Yeah, I think, yeah. So I'm pretty sure, or gold or silver, or, oh, it's a silver company. So, okay, Helka Mining owns a bunch of mines. So Greens Creek, Casa Verde, Lucky Friday, and I guess they're silver mines. So 45% of the revenue comes from Canada, 43% Korea, but this should just follow whatever silver is doing. So look at that growth. Wow, the sales are up 80% year over year, and their net income is up 1,000% to 134 million, which means their net margin is like a 30%. Yeah, look at that margin expansion. This is why the price of silver going up is so good for them because they're break even, like what the price of silver needs to be like. They're just net making so much money right now because of the price of silver being so high. And look how they crushed expectations. They expected 355, they did 448. Expected 95 in net income, they did 134. So it really was a big beat of a quarter. 22 forward PE. So this is really a silver proxy, and silver, the commodity, is ticker symbol SLV. And yeah, as you can see, the two stocks look very similar. Like a month ago was when they peaked out, and they're kind of a little bit off their peak. So interesting silver name there. But don't buy airline stocks. That's the worst idea. Rare earth and biotechs right now are where it's at. Oh, hey, what's up, TOK? Yeah, I'm not a big fan of the airlines, especially it's the long term. But why is it down? I think it's just down because of silver being down. That would be my guess. Because it's not because they missed on some financial metric. It's just probably whatever the algorithms are doing for silver, if I had to guess. So here's Tesla. This one, hey, what's up, Matt? So I am not too bullish on the long-term outlook of Tesla. Tesla outlines optimist pivot and 20 billion capex. Tesla completes supervised autonomous road test in Abu Dhabi. Tesla ramps Cybercab reduction plan amid regulatory hurdles. Toyota and Stellantis exit Tesla-led. Okay, anyway, I just can't. The only thing I don't like about Tesla is their valuation. And Tesla is like a mind of its own, I know, but I just can't get behind paying a 300 times forward PE. And I even myself, I look at like the 2028, 2029 EPS projections, and it's still expensive using EPS numbers really far out. And they're expecting, and I don't even know if I fully trust these, like they're expecting all this like gains from robotics and robotaxis, but like I think there's going to be more competition than people think. Google with Waymo is already huge, and Tesla, if we just judge them off the right now fundamentals, it's very bad. So the sales, the revenue, the lifeblood of the company, the revenue on Tesla is down 3% year over year. So the revenue is negative. So the revenue's down 3, but here's the worst part. The net income is down by 60 because they just lost their tax credits, their EV tax credits. It's making their margins go down even worse. So if we go to their net margin over time, look at how it's just like, it's the lowest it's ever been. They used to have a very respectable, double digit, over 10% net margin with the tax credits and stuff. But now it's like, it's just getting worse and worse, only a 3.4% net margin. And that's real too. Like this isn't just a one-time adjustment. Like the margins are fortunately going down, and the revenue really is negative year over year. It's mainly just from the automotive segment. Like the automotive, their car sales, it's down 7% after it fell 4%. So that's why out of all the growth stories that exist out there, I can't pay for this super expensive one. Like there's growth stories, I believe, that are way better opportunities. Plus the law of large numbers makes Tesla a hard double. They're worth 1.5 trillion. For you to double your money, they have to be worth 3 trillion. And they're already at such an insane multiple. I can't see them. So I'll stop talking about Tesla because probably losing viewers on being embarrassed on Tesla, but I just try and keep it real. Like I really don't like Tesla, just from a valuation point of view. Ooh, hey, what's up? Someone said, hey, what's up, Eric? Oh yeah, UiPath. Yeah, I forgot to look at that one. Sadly, I have nothing really good to say about UiPath. It's not one I'd really recommend anyone buy. Out of all the software names you can buy on the dip, I wouldn't really buy UiPath, and I'm not buying UiPath. And again, if you look at the very bottom right, I've been holding UiPath since 2021. I can label every sort of bad news event that's ever happened to UiPath, from the CEO quitting out of nowhere, leaving the team for dead. That happened on this day right here. Look, there's no earnings report. There's no E right here. The CEO just quit out of nowhere. He was so greedy and took all this money. And the stock's just been down ever since. But they're finally getting to they're just too cheap for me to fully sell out of them. They're finally getting like net income positive. Like if we zoom out, they used to lose like, a lot of money every quarter, but now it's still not even like that great, but they're potentially going to be a point where they're going to be actually finally making net income every single quarter, which would be good to see. They also have no net debt, which is good. I believe they have like $1 billion of net cash or something. So like 20% of the market cap is their net cash. I know they're cheap at like a 26 forward PE. That's why I'm not selling them, because they're cheap. They're too cheap to sell. You certainly, if you're a shareholder and you're down, certainly don't fully sell out of your position, because I do think it's going to rebound. But I've just been so beaten down with that company since 2021. So the software stock, actually, speaking of software names that I saw in the dip, like out of all the software names I saw in the dip, I actually bought AppLovin. I was very impressed with AppLovin's financials. So I bought this one about a week ago. Yeah, there's my little buy order right there. That's one of the best software names I saw. Ooh, I saw Microsoft. Hey, please talk clearly. We cannot understand your words. We're not American. Hey, I'm sorry about that, Fazo. By the way, I am streaming on YouTube, so if I talk too fast or something, you are able to like rewind it and replay it on YouTube, but I am sorry if it's hard to understand. So here's Microsoft. Every company in one way or another like uses Microsoft. Yeah, hey, what's up, Liam? We'll check out Microsoft. They own 27% of OpenAI, which owns ChatGPT. Let's see if there's any OpenAI launches ChatGPT 5.4 model. Microsoft-backed OpenAI reaches $25 billion in annualized revenue. That's good. 28% reduction in hallucination rates, which is good. That's been a bad thing around AI chatbots. But anyway, if we just judge Microsoft off their fundamentals, they're so cheap. Hey, my YouTube channel is called Nathan Robert. You can just type into YouTube Nathan Robert. I'm also, it's also in the link tree in my bio. It's like the third link in the link tree in my bio. You can just type in YouTube Nathan Robert. It should be the first result, and the stream stays up there forever. But yeah, look at the forward PE on Microsoft. They're only trading at 23 times next year's net income. And for Microsoft, I think that is very fair. Only 23 times next year's net income. And they're also raising their Office 365 prices. So yeah, look at this. Here it is. Microsoft implements double-digit price increases across enterprise agreements effective November 2025. This was their first price increase on their software business. So think of Excel, PowerPoint, Word, all those kind of apps, that enterprise software. They did their first price increase in over 10 years. So I'm expecting a nice little tailwind to their software business. And this is their software Office 365 revenue. That does over $120 billion of annual revenue for Microsoft, which is just huge. And also, they're right now capturing this cloud spend. So they have this intelligent cloud. The Microsoft Azure cloud just took 1%, I think, market share away from AWS. It's doing amazing. It does over $106 billion of annual revenue for Microsoft as well, which is just nuts. And we can see the net income projections. It's going to go from 27 to 31. Historically, they beat on net income every quarter. And they had a one-time adjustment. They didn't actually do 38 bill of net income. They did like 31. But we can see from the EBIT, even on earnings before interest and taxes, they beat every quarter by a good chunk. So we're seeing a disconnect. Like the stock is like well off its all-time high, and it's not for any like fundamental reason. It's just a sentiment reason. And that's why I would absolutely like, this is out of all the stocks you could buy right now, I think this is like got to be my second or third favorite, or like top three for sure, best buys to just like buy and never sell. Not financial advice. If you buy it now, you should just get like 8% of your money back a year for the rest of time, or whatever the S&P 500 is doing. At a 22 forward PE, doing dividends, doing share buybacks, investing in OpenAI and AI. They're spending right now. One thing being questioned is their new updated CapEx. They're going to be spending like 40, 50 billion every single quarter for the next couple quarters in a row. But that doesn't scare me out of Microsoft or Google or Meta. I think it's a steal of a deal at a 22 forward PE, and I don't see it getting much cheaper than a 22 forward PE. So someone said ASTS Space Mobile or Prentice, what's up? And then we'll do CX. We'll check out these. What's up, Riaz? Well, we'll think the market will be Monday. That all depends. That's a great question because I think the war tensions have only escalated since Friday. So we definitely don't want to see oil stocks go up again, which is just a drag on the economy, basically an added tax for everyone just to live and go somewhere. It just costs more. Like for the bigger vehicles, it's going to cost potentially like in the triple digits to refill your car. And actually, speaking of this, that's actually that why MUSA is going up. This is a gas station play. And last time oil prices were really high, the psychology on this kind of makes sense. People don't fill up their tank all the way. People actually only partially fill up their tank when oil prices are super high, leading people to go to gas stations more often than they would. And so these gas stations actually sell more merchandise like candy bars and Monster Energy drinks and stuff like that. So actually, that's why Murphy USA on Friday was actually up 5%. This is a pure gas station play. They're opening up 50 new gas stations in 2026. So that was kind of off topic though. Let's get back to that stock you were talking about. Yeah, ASTS. So this is a decent space contract company. They're getting their first ever sort of revenue. Let's see if there's any news. Oh, wow, there's a lot of news. So ASTS secures a $30 million contract with U.S. Space Development Agency. Orange, which is a datacom company, partners with AST Space Mobile for direct-to-cell trials in Romania. Vodafone and ASTS Space Mobile launched Satellite Europe Joint Connect venture. Wow, there's a lot of news here. AST secures spectrum agreements with Legato. So let's actually go check out their revenue right here. ASTS successfully deployed Bluebird 6 with largest commercial LEO communications array, plans to add 45 to 60 satellites by the end of 2026. So basically, it's the future expectations of this company that's been so bullish, and they crushed it. No way. I just kind of sneak peek gave it away. But basically, this company is converting from a company that does no revenue. Like, look, before today, they were doing $1 million in revenue, $700K, $1 million. They had no revenue. This quarter was really good at $15 million, but guess what they just reported? $55 million in revenue this quarter. It was great. So the future expectations are very strong. The revenue is going to go literally from 1 million to 40 million year over year. So this year specifically is like the year we watch for them because they're converting from a company doing 100K or $1 million in revenue to now like 40 to 50 million in revenue a quarter. And there seems to be a lot of positive sentiment around, adding 40 to 50 new satellites in 2026. So I don't love the net income losses, or let's check the EBIT. So yeah, see, they're losing like 70, 80 million a quarter. Losses are supposed to worsen. But that's okay because they're just like, for the amount of growth that they're experiencing so rapidly, it's okay for them to lose money. That's not an issue right now. But as long as they keep beating on revenue expectations like this, the stock momentum will probably just continue to climb higher. But that's, again, not one I trust with like anything meaningful. I'd probably keep the allocation of that one a little low. Is this platform for only investors? Not really. Yeah, actually, you can download this app I'm on and still analyze stocks the same way I am. Some features you don't get. Like if I click on Moog right here or any stock, you see how it says analyst rating member next to it? You have to be a member to see these stats like the Morningstar research. And you're wondering, how do you become a member? All you have to do is have $100 deposited, and there's no monthly fees. There's no way to pay them. Yeah, if you want to get this app I'm on, it's in the link in the description or the very first link in the link tree in my bio. Brokerage called Moomoo. Get a 3.35% APY on your idle cash. There's a lot of cool features like you can track all the super investors and analyze stocks. Yeah, anyway, let's get back to your analysis. So Norbero said CX stock. What is that? So this one, if we zoom out, has not done too well on the monthly. Technically, Cemex, or however you pronounce it, is the same price that it was in 2004. So the stock has not done too well. What do they sell? So a 13 forward PE. From the sale of goods associated with main activities. Well, what's their main activities? Building materials. So do they literally sell just like cement? I think Cemex, I've heard of them before. Do they literally just sell cement? Cemex to acquire Omega products. Yeah, I think they literally sell like either cement trucks or something like that. Products and solutions. We formulate our cement products to offer exceptional strength, durability, and workability. So yeah, they just sell a commodity, and they're headquartered in Mexico, did they say? Yeah, so this company is actually headquartered in Mexico, full disclosure. Interesting. So let's check out their bottom line. What are they selling this commodity for? It looks like they had a one-time adjustment, but historically, this is the before tax number, so we'll subtract 20% from this. But historically, they're making like 300 million to 250 million of, after tax net income a quarter. So it's actually not too shabby. Again, looks like they had a one-time adjustment. They didn't actually lose 360 million this quarter. They made 400 million. So yeah, that's why the forward PE is a 13. So there's your cement play. Actually, I have a better stock for you. If you like a building materials play, I'm actually bullish on the commodity of limestone specifically. This is a hidden gem stock for y'all. I got you guys. This is USLM. They sell limestone. This company has no net debt. Over 10% of the market cap is just literally their cash on hand. They literally sell limestone for a 38 or 30% plus net margin. I kid you not. And this is real too. And look at this balance sheet too. Everything about this company I fell in love with. First off, takes a lot of risk off the table. The fact that they literally have no debt. They have 371 million of cash. Notice their cash pile grows every quarter. So they have 370 million of cash. The whole company's worth 3.3 billion. So yeah, over 10% of what you're paying is just their cash on hand. And here's their net income. So the revenue is 87 million. On the 87 million of revenue, they netted 30 million. And guess what? This company also pays a dividend. They have a 0.2% dividend, but notice the payout ratio. It's only a 5% payout ratio, and they raise their dividend every year pretty dramatically. So yeah, they made 30 million just this quarter, and they have 380 million of cash. The dividend that they have, they pay a dividend. Where is this? The dividend cost, it's literally nothing. 1.7 million a quarter. So the dividend cost 1 million a quarter. And since they have so much cash on hand, they're actually earning interest. They literally make more interest on their cash a quarter. They made almost 4 million of just interest on their 370 million of cash. So hopefully y'all found that one kind of interesting. I still am looking to buy the dip on this one potentially, but yeah, like their limestone business has really just been doing amazing. Let me go to their products real quick. Yeah, so high calcium quick lime, lime slurry, hydrated lime, all that. So pretty cool. And they apparently sell this commodity here at a 35% plus net margin with no debt, 25 PE, 10% of the market cap is cash. Let me know what y'all think. I try and introduce y'all to new stocks sometimes. I try not to just go over like Apple every time. Yo, what's up, Agent? Good to see you, homie. Monday, Hims is the play, 40% up. Yeah, Hims, they finally resolved their dispute with Novo Nordisk. Ooh, NDAQ. Hey, what's up, Truth Seeker and Paul? Yeah, we'll do NDAQ after this. And hey, what's up, Lulu? Good to see y'all. Yeah, actually, let me do NDAQ first. So I think this actual NASDAQ publicly traded. So the actual like NASDAQ stock exchange is publicly traded. So when I say NASDAQ, don't think of the QQQ because they're also called like the NASDAQ 100. But this is the actual, like they collect royalties. The people using the NASDAQ 100 name pays royalties back to this company right here. So the forward PE is pretty fair. So that's why this one might continue to climb higher. Like they're not exactly expensive at a 20, like even though they're close to an all-time high, they're only at a 27 times next year's net income. Yeah, so they do market services. Yeah, capital access platforms, IPOing, the New York Stock Exchange, or actually, no, I don't think that's it. But yeah, the financial technology. So let's see what their net income is every quarter. This is in US dollars too. They actually make a lot more than I thought. So the revenue grew 4%. So the revenue is up 4%, kind of low growth. So the revenue is up 4, but the net income is up by 45. That means there's crazy net margin expansions. Literally their net margin went from a 17 to a 24. That I actually can't believe. That is impressive margin expansion. So great net income numbers right here. Yeah, the highest net income quarter ever was this quarter right here. 520 mil in net income. Do they pay a dividend? Yeah, even though the stock is where it's at now, you get over a 1.2% dividend, safe payout ratio. They raise their dividend every year. Safe forward PE, that could go higher. That's actually quite interesting. US is 72% of their business, so it's actually a nice little dividend growth company, I will say. Nice one there, Paul. Appreciate that. What's your 2 favorite stocks for long term? Well, hey, just right now specifically, I really like not McDonald's. Well, I do like McDonald's, but not at its current valuation. I like Microsoft. I really like Microsoft stock right now. I think their valuation is very fair. WLMT. Do you mean Walmart? Let me know. I'm almost certain you mean Walmart when you said WLMT. Hades said Marvel. So what's up, Hades? They had a great earnings report. They really did. They beat on net income by over 100 million. It was like a 30% beat or something. I think I can pull it up here. Oh, they used to like, let me see if they'll actually generate one. No, that's okay. They gave 2028 guidance. It should show up down here. Yeah, right here. So Marvel Technologies reports record Q4 revenue of 2.2 billion. They rose their full year 2027 guidance to 11 billion. In the full year 2028 guidance to 15 billion on AI data center demand. So that means like their revenue is going to CAGR at like 30% or even more through 2028 if they're going to be doing 15 billion. Marvel projects data center revenue to grow nearly 50% year over year in fiscal 2028. Marvel launches industry's first 2 nanometer coherent DSP with a 1.6 something ZR plus data center interconnect chip. Let's go trying to understand that. Let's just go look at their actual fundamentals and what they reported. So it was a net income beat specifically. Like, look at this. They expected 294 and they did 394. It's hard to see because last quarter kind of skewed it. But anyway, we can also see how their future projections are great. We can see the revenue is going to go from 2 billion to 2.58 billion. EBIT's going to go from 690 to 940. And they're potentially going to beat like crazy on these expectations too, if the way they have been and how they just rose guidance. And yeah, these aren't even the updated numbers from 2 days ago. Guidance numbers. Oh, do beware, looks like 43% of their largest customer is China. The US is the second largest, though. US is 16% of sales. So yeah, that data, it looks like one of the data center beneficiary. And I love that they're finally really profitable. Here's their profits right here. If we zoom out, there's a tough buyback here, losing a couple $100 million a quarter. But now the business is booming because of AI. They're really now making a couple $100 million of net income a quarter. So that's Marvel. Yeah, hey, dang, I haven't even realized we have been live for 2 hours and 39 minutes. I've been having a great time. Yeah, if y'all want to hit the follow button, feel free. I'm trying to stream every day. We just look at y'all stocks. I sell nothing, no course, book. I don't coach, nothing like that. Just on here giving my opinion. You think gold and silver could go higher? That is interesting. You know, they're kind of seen as like a safe haven asset. If war escalations or if war starts to escalate again, that could be interesting. Maybe gold could go up. But I don't know. I don't own gold or silver right now. So here's Simon Property Group. This is a mall REIT, and they really pivoted back in 2020. So basically, instead of making the malls aren't doing too well, instead of making the tenants pay like $500 a month or whatever, they do like a revenue share agreement where they just take a certain percent of your sales. So the mall REITs or the Simon Property Group actually hasn't been doing too bad. You get a nice dividend too. Look at that. You get 4.4% of your money back just in a dividend every year. But again, historically, if we zoom out, you're not really going to outperform the tech-heavy S&P 500 with the mall REIT. You know, the stock is technically the same price that it was in 2014 over a decade ago. But what you do get is, 4.4% of your money back every year in a unqualified dividend. And it really hasn't done any stock price appreciation. So yeah, it really has just historically underperformed the S&P, but they've done great recently. Surprisingly good this past couple weeks. But yeah, they do triple net leases. So yeah, they have high gross margins, just like all the triple net lease REITs. But yeah, they specifically focus on malls. And again, the reason they have such a high dividend is because they have to pay out 90% of their taxable income in the form of a dividend. Yeah, hey, Mr. Powell, what's up? He said BBAI. I've been kind of avoiding this one because I don't really have too much good news to say about this stock. But actually, it's because they're kind of tiny. Well, let's just analyze them. You know what? Let me just forget about everything because they did just report earnings. Okay, so let's actually go look at their recent earnings report. So here's kind of what AI is saying. So the revenue dropped significantly due to lower volumes on U.S. Army programs, impacting overall top-line performance. Profitability improved with the reduced net loss and EPS beat despite margin contraction. Okay, so let's go see. Some sort of U.S. Army contract. So yeah, that was a miss. Looks like analysts expected 33 mil. They only did 27 mil of revenue. And if we go to their net income right here, looks like they're losing like 20 million a quarter. but they did just fortify their balance sheet. So probably from dilution. Yeah, dang. So they just diluted the shareholder by 20%. So every shareholder has been diluted by 20% just in the past 2 quarters. So you own 20% less of the company. But now the company has $590 million of cash. And that's an insane amount of cash. So that's how they can afford, kind of last quarter when they had to $220 million loss. That's why they had to do that dilution to kind of pay that off. Nothing's really blowing me away if I'm being honest here. I mean, revenue expectations are literally negative and they've been missing. Like revenue was 40 mil and it's falling to 35 mil. So I just don't know about this company. I would keep the allocation of that one pretty low because they're not profitable yet. Oh, yes, Walmart. Oh, yeah, Walmart. Yeah. So this one's a nice defense play. The past couple weeks and months, a lot of software and AI names have been really struggling, but not Walmart because they're a nice defensive stock. Like in 2008, Walmart and McDonald's were like the best two performing stocks because they're seen as somewhat recession resilient, kind of recession proof. Let's see if we can get a recap of their earnings here. Comp sales rose 6%. They have one of the best real estate portfolios in the world. But yeah, what I love about Walmart is their online presence. Like they're up there with Amazon where they can really, it's like Amazon and Walmart are the best like grocery deliverers. So global e-commerce sales surged 24%, accounting for 23% of the total net sales, marking 15 consecutive double-digit growth quarters. High margin businesses showed strong growth, with global advertising up 37% and the membership income increased over 15%, driven by Sam's Club and Walmart Plus. I actually just became a Sam's Club member 2 weeks ago. So, hey, I'm helping out the stock. So yeah, Sam's Club, I love that business model. You have to pay for a subscription just to get into the store. And whether or not you go to the store, they're collecting that subscription revenue. But check out their net income down here. Like it's so good. They're easily making a couple, like usually $5 billion of net income a quarter. So, they're growing their online presence. So they're just like the best grocery store play. And a lot of these other grocery stores have been struggling, like a Sprouts Farmers Market. I think they're just kind of being out innovated by a Walmart and by a Amazon, because like Amazon Whole Foods, they will deliver you that stuff to your door, but Sprouts Farmers Market doesn't do that. So yeah, Walmart, I've actually been very impressed with how the stock has been doing. I don't think I'd buy them here because they're expensive, more expensive than like all the Mag 7 at like a 44 forward PE. But yeah. Oh, hey, so Michael Anthony, what's up? He said Broadcom went up on earnings. Let's see if it'll sell off next week. All right, let's check out Broadcom really quickly. I like their TPU business right now. That's really in demand. Let's see. Broadcom reports Q1 earnings above estimates, projects AI revenue to exceed $100 billion in fiscal 2027. That's pretty insane. Broadcom authorizes $10 billion share buyback program. Yeah, Broadcom projects Q2 revenue of $22 billion and AI chip revenue to exceed $100 billion. So let's go. So they expected $22 billion just next quarter. Look at that. Literally just next quarter. And look at their revenue right now. Or maybe that's 2 quarters now, but they did $18 billion in revenue and they're expecting $22 billion. So that's nice guidance. Were analysts expecting that? Oh yeah. So $22 billion is the estimate next quarter, because that's what they gave. And then the quarter after is $29 billion in revenue. Check out those future expectations. Hold up. I mean, look at the net income. It's going to go from $5 billion to $12 billion. $12 billion a year annualized. That's like what, 46 billion or 48 billion of net income a year. That's why the forward PE is so lower than its current PE. Yeah, net income's doubling. So PE is a 64 and it's going to a 31. It's falling in half. So net income's going to double. So you really look at a multiple year out forward multiple here. So their semiconductor like TPU solutions, that's up 35% year over year. That's the highest growth rate on the entire screen. That's why I think Broadcom's kind of being rewarded right now. It's the highest growth rate. So yeah. And you get a nice dividend, a 0.71% dividend. Yeah, nice little like NVIDIA alternative. Dylan said GFS. What's this one? Global Foundries. I have not heard of this stock before. So it looks like they IPO'd in 2021. Wafer revenue. So maybe they sell some sort of wafer chips. So it looks like the revenue has been kind of flat. Not too impressive here, like 0% revenue growth, -3%, 2%. So like low single digit growth. But the past couple quarters are surprising, and this is real. Actually, this really is real. They really do make 200 mil a quarter. and have like no net debt. Are analysts projecting that? So yeah, they see that too. They're supposed to say at 140 million. So what's the forward PE here? That's what I should have checked. So it is still a little expensive. Like Taiwan Semiconductor is significantly cheaper. They're at like a 24 forward PE. So this one's at a 32 forward PE. Wafer revenue, US is 50% of the revenue. So anyway, I don't see anything wrong with this company. Valuation still, like, even at this current price, the valuation still seems a little high, but they really are making like 200 mil a quarter. I guess it's supposed to fall to 150 mil next quarter. Here's their website right here: essential chips, smart mobile devices, so maybe 5G chips or something, automotive chips, communications and data center chips. They're in aerospace and defense. So that's, I guess, their website right there. Semiconductor play. Interesting. All right, we'll look at a few more stocks here. Then I got to go because my head is hurting a little bit. We've been live for 3 hours. Joe said Neo. Sadly, I don't have anything good to say about. Oh, hey, what's up? Tragon's Fitness. I didn't even see you, man. Good to see you. My bad. Hope you're having a good day. GFS is just a chip fabricator. They don't design chips. Okay. Oh, so kind of like a Taiwan Semi and an Intel. Yeah, thanks for that, Dylan. I appreciate you. So yeah, here's Neo right here. This is one of the like worser EV plays. This is a Chinese EV company. Let's see if there's any news. Neo's chip raises over 2.2 billion won in funding at 10 billion valuation or won valuation. Okay, the bad news about Neo is just the net income losses. Like this is in US dollars as well. Like they lost 488 million this quarter. Like, so first off, they sell a commodity like Ford. Ford is lucky to get a 3% net margin selling their cars. And here's Neo. All they do is sell electric cars through a Chinese electric vehicle producer. I just don't see like the real end. Like it's a single digit, super competitive industry. Like I'd rather own BYD than Neo because they can scale way faster and better. I just don't see the end game here because they just burn through money. Like this is just not the kind of stock I'd want to own. One that loses 400 million to $1 billion a quarter. They're really leveraged and they're diluting the life out of you. This isn't from issuing debt. This is from diluting shares while the stock's at all-time lows. They've diluted you by multiple $1 billion. Actually, I'll show you the sad reality of what that does. Here's how diluting you at all-time lows erodes shareholder value. So if we just go to the total common shares outstanding, let me pull it up super quickly. So check this out. Diluted weighted average shares. Look at over time. It's just up and to the right. In 2021, there was 1.7 billion shares. Now there's 2.43 billion shares. So they diluted you 18%. So you own 18% less of the company after you lost another 18% ownership in the company the year before. I don't know. I just don't love the net. And here's it in Chinese currency. They're losing like 5 bill a quarter. But in US dollars, they lose like 500 mil to $1 bill. I'd just be careful with Neo. I'd maybe rather own Tesla, but I just don't love that whole EV car industry. BYD might be the best. Nicolo said CDNS. Yo, this is Cadence Design. Let me actually see what they do because I can't explain it exactly. I know they had a good earnings report. They're a big partner with NVIDIA. They get a lot of shout outs from NVIDIA. So the core EDA business grew 13%, fueled by AI-driven solutions and strong hyperscaler command. Their IP business revenue increased 25%, driven by high-performance computing. System design and analysis expanded 13%, supported by demand for their 3D IC platforms and AI infrastructure simulation solutions. So some sort of like semiconductor system design analysis, semiconductor IP business. Wow, their semiconductor intellectual property business is growing very nicely. But they make great net income. If we look at the bottom, like their quality, they really do make a couple $100 million. This was a record quarter, specifically for almost 400 million of after-tax net income. They really do make a couple $100 million a quarter. So what's their net margin? Yeah, 26% net margin this quarter. That's actually really good. But they're really expensive. That's probably the bad news. Yeah, 59 forward PE, but it's much better than their 73 PE. Morningstar has it at a $330 price. I guess here's what the bulls are saying and what the bears are saying. With limited competition and products that are essential in support of the semiconductor industry, which generate more than 500 billion in annual revenue, Cadence's moat is wide and durable. Secular tailwinds such as physical AI and AI tools will drive new chip design starts, raise R&D intensity, and open up new markets for semiconductor-focused EDA tools, leading excess revenue growth for 10 years or more. So that's a lot. Anyway, I won't read through all those, but yeah, Cadence seems pretty interesting and niche. PSI. What is PSI? So, Invesco Dynamic Semiconductor ETF. So yeah, if you don't know which semiconductor stock to buy, like if you don't want to buy Nvidia or Broadcom or Micron, this ETF kind of just breaks your money up for you into all the stocks. Look, actually, Broadcom is the largest holding in PSI, and one in SMH, like Nvidia, is the largest holding. So interesting there. And they also own Enlight. Hey, that's interesting. We were just analyzing them. Can you explain PE ratio to me, why it's so important? So yeah, basically the PE ratio is price to net income. So check this out. Or it's price to net income plus any share buybacks or dilution. But basically just call it price to net income. So Amazon right now on the left, the PE, their price to earnings trailing 12 months, they trade at 29 times right now as net income. But the forward PE, which uses the next 12 months, they trade at 27 times next year's net income. So yeah. And I really like that he uses the PE ratio because companies like Neo, they can dilute you by 30%, where it looks like like if the net income grows by 30%, but they dilute you by 30%, the EPS is flat. So it's great that you look at the forward PE and you want it to be lower than its current PE. And the PE ratio does not give them the benefit of the doubt. So it's a great metric, I think. And every industry is different. Like oil stocks should trade at like low teen multiples. So all depends. Oh, like dang, PayPal has been struggling. Like General Motors. So General Motors is a better buy than Ford, for sure. Let's actually see what they trade at. Like this company specifically trades at such a low multiple. Like look at the forward PE. They trade at 6 times next year's net income, and that's just kind of normal for this whole low margin industry. Like let's see what their net margin is. So yeah, it's a little choppy, but yeah, historically like a 5 to 6% net margin. Looks like the net income has been struggling a little bit these past few quarters specifically. I don't know if it's like a one-time adjustment from tariffs or something. But yeah, you get a nice dividend, or I guess a near 1% dividend, low payout ratio, 6 forward PE. But I don't know if this stock will really outperform the tech-heavy S&P 500 in the long run. Looks like they did miss a little bit. But yeah, look at that. The revenue, the sales are actually down 5% year over year. Yeah, it looks like they really did lose 3.6 billion. I don't know what happened there. But anyway, GM recalls 11,700 US vehicles over engine stall crash risk. Canada proposes tradable credit systems for auto imports. Reduces quotas for GM Insta launches. I guess that's bearish for them. All right. Bro, Hims and Hers recently pumped. SATS stock. Yeah, hey, try not to spam there. Oh yeah, this is yeah, this stock just got added into the S&P 500. So I think that's why this one's up after hours. So yeah, the S&P 500 got a few new stocks. Yeah, Lumentum, Coherent, and EchoStar to join the S&P 500. So what does this company do? So they do like, isn't this like something for your car or something like pay TV? So this isn't great. This is like a business that kind of declines single digits. Like, look, the revenue's down 10% after it fell 6%. It's just like all year over year declines. What about their wireless business? That's up 4. Broadband is, dang, that's down super double digits as well. So if we go to the total revenue right here, like, I mean, that's not really what you want to see. The revenue is kind of just declining down and down and down. But are they profitable? Well, dang, they lost 12. That had to have been a one-time adjustment, but it really leveraged up their balance sheet. Oh my goodness, it super leveraged up their balance sheet. I don't know. The stock has done great though. Like there must have been some sort of good news. Like I remember, I think I heard some sort of partnership with SpaceX with this company. Oh yeah, so yeah, Catherine said it deals with Starlink. Oh yeah, so SpaceX I think owns Starlink. So yeah, they had a deal with Starlink or something like that. I wonder why they got added into the S&P 500. I'm actually really surprised. Because they don't make money. And the revenue's down. Is it just because of the market cap? They're worth $30 billion. Huh. Can PE work for picking options? Not really. That you don't really look at PE ratio if you're doing options. What was the one? Oh, Celsius. Yeah, we'll look at a few more here. Then I gotta go because dang, we've been live for basically 3 hours. So if you want to hit the follow button, though, I appreciate that. Here's Celsius. They now have a 28% energy drink market share in the US. So they actually have a pretty big market share, and they just finalized their acquisition of Alani and Rockstar. So yeah, check out the number 2 line here. Celsius reports fiscal 2025 revenue up 86%, driven by the Alani acquisition and Rockstar acquisition. So that was actually pretty cool. I'll actually show you that. So if we go to their cash from investing activities, 2 quarters ago, they spent $1.3 billion buying Alani. Again, you want their cash from investing activities to be negative. That means they're buying assets. They're not like actively selling out of their own assets. Let's see how, look at that forward PE. They're only at a 26 forward PE. So that's why this stock's actually pretty decent. They're only trading at 26 times next year's net income. That's actually pretty interesting. Let's see if we can get an AI recap for the stock. The core Celsius brand showed strong organic growth. Acquired brands Alani and Rockstar added approximately $1 billion in revenue. Adjusted EBITDA more than doubled. Basically they have a huge market share, like a 28% market share. The 26 forward PE actually seems very attractive because they had a one-time distribution termination fee cost last quarter. It says they lost $60 million. This quarter, they actually made $100 million, but they had like a one-time $180 million termination fee as they're switching their distribution from some random bottler to Pepsi. Actually, Pepsi has a big stake in this company. That's how they got Rockstar Beverage. Rockstar Beverage used to be owned by Pepsi. Pepsi actually gave them Rockstar Beverage so they can actually bottle for them. And they took a stake into Celsius and gave them a bunch of money. So that's good to know. Should only bring up their margins in the future. And Honest, he said, what are your thoughts on bull earnings? I was actually slightly disappointed on their net income numbers. I haven't deep dive into Webull too much. Their numbers, just because they're such a small position for me. Let's see if there's any news. Webull reports Q4 full year earnings. The revenue growth was incredible. Their customer assets went up by 81%. Funded accounts grew 8% to 5 million. Registered users rising 50% to 26.8 million registered users. But they only made a couple million in net income this quarter. Actually, I don't think it's loaded in down here yet. So basically right here, here I'll show you the revenue growth. The revenue was 165 million, which was great, which grew 55%, but analysts expected 16 million. They only did 3 million in revenue. They still made positive net income, but I was really hoping that they would have made a lot more net income because of their, and I'm a Webull user, because of their prediction market stuff. Webull just added in prediction markets, crypto, and Webull subscription to the app. That's why it says new in the top right on prediction market and crypto, because they just added this. That's why I thought they were gonna, dang, we're getting another AFK thing. This is a CAPTCHA if I've ever seen one. Okay. I've never seen them do one like that. Okay, dang. That was every single hour, if I don't click the TikTok live app, it makes me fill out a CAPTCHA. And this is the third time I've clicked it out because I just hit the 3-hour live mark on the YouTube stream. Check that out. Dang, 3 hours. Thank you to everyone that's still here, because TikTok already removed my stream from For You page eligibility like an hour ago. So I can't get any new viewers in here, but to the 28 people, I appreciate y'all. And thanks to everyone on the YouTube stream too. Best way to support me is just watch the stream from YouTube. I'm trying to build up my YouTube channel. It's called Nathan Roberts. Also in the link tree in my bio. But also let me show you my Webull position. Come on, load for me. There we go. So if I go to my Roth IRA, they're one of my smallest positions for a reason, because even though Webull's at an all-time low right now, down 65% all-time since its IPO, they're still expensive even at this all-time low level. So that's why I keep in the allocation of this one very low, but I still have a small allocation of this one because I'm just more bullish than the analysts are because of the crypto prediction market and the Webull premium subscription. And I think they gave a Webull premium subscription numbers. I can't find it on the screen. Anyway, they actually have a lot of Webull premium subscribers now. What can we look at as the last stock here? Hey, thanks, Ocean. I appreciate you, Ocean. Prem said HIMS. Quick news on this stock right here. There's a lot of history to talk about. If you look in the after hours, they're up 40% after hours. So basically, one of the reasons why the stock fell so much this day, there's a lot of history. I'll kind of be quick here. Hims and Hers used to sell Ozempic and Wegovy on their website, and Ozempic and Wegovy is owned by Novo Nordisk. But then way back here on this day right here, Novo Nordisk out of nowhere abruptly ended their partnership. So Hims and Hers was no longer selling a weight loss prescription on their website. So they actually, about a month ago, created their own knockoff Wegovy prescription. And then Novo Nordisk got so mad and sued them and sent like a bunch of reports to the SEC and stuff. And that's why they tanked this day. There was no earnings reports this day. The reason they gapped down like 40% was because of this lawsuit. But now what just came out the news, Novo Nordisk and Hims and Hers Health to settle their legal dispute, and they're actually forming a partnership on an obesity drug distribution. And you know why they're doing that? Because Novo Nordisk is in the toilet. Their stock is. I mean, their stock is literally like so far. They were $140 a share a year ago. Now they're $40 a share because they're just being out innovated and they're losing their patents on Ozempic and Wegovy. Anyway, this is just great news for Hims and Hers that this whole issue around FDA issue, legal dispute is all over. FDA issues second warning to Novo Nordisk over misleading Ozempic advertising. So this is a company that 93% of this company's revenue is their diabetes and obesity care, those weight loss products. Hey, thanks, Good Luck. He said, best live. I appreciate you. Good Luck. I appreciate you. Can you check ADP? It's similar to your petrol station stock. ADP is actually... you must be talking about maybe this stock or ADP. You know, that's the ADP report, like the ADP jobs report we just got. That's this company right here. But maybe I'm wrong. Yeah, this is a software company. I did look up ADP though, but you're saying it's a gas station stock. But yeah, this is the company that just gave like that ADP jobs report that just came out. Anyway. Verizon, yeah, Verizon's a stock you buy to maximize your income. You're not gonna outperform the S&P 500 owning Verizon in the long run. Like if you look at Verizon, they're technically the same price as they were back in 1998, but you buy them because they really do have a safe 4% dividend. So historically, what you get is 4% of your money back in a dividend, and then you kind of hope for a couple percent stock price appreciation every year. Historically, they haven't given that, but this month specifically has been a rocket ship for these boring names. Like look at Verizon, they're up like 20, 30% just in stock price. And again, it's not just Verizon that's done really bad since 1998. Look at AT&T, their big other main competitor. AT&T stock is also literally the same price that they were back in 1998. So it's just like this whole sector, telecom, like doesn't really outperform the tech-heavy S&P 500 in the long run, but you do get the nice sustainable dividend. Like they really do pay a qualified, safe 50% payout ratio dividend. So all right, the very last one, or Lululemon, an honest company. Let me just do Lululemon as the last one. So Lululemon, let's see. Lululemon founder Dennis Wilson launches proxy fight for board. Lululemon launches Show Zero sweat concealing fabric technology in collaboration with tennis player Francis Tiafoe. Okay, well, anyway, a lot of these apparel stocks have not been doing too well. And again, it's not just Lululemon. Nike is doing terrible. Under Armour is, like, look at Nike stock. And I used to own Nike. And Louis Vuitton isn't doing too well either. But Nike stock is the same price as they were, back in 2015. You don't want to see Under Armour. I think that's UAA. Yeah, Under Armour. They're the same price as they were back in 2007. So a lot of these apparel names are really getting hurt right now. But Lululemon is one of the better ones. If I had to buy the dip on one, I'd pick like a Louis Vuitton over Lululemon. But they still print net income. If we check this out, they really still make like a couple $100 million, like $300 to $400 million in net income a quarter. But one good competitor is actually Amazon. Amazon, their own private label brand, literally has like a 25% market share, a huge market share. But yeah, they still literally, why I'm not completely dismissing Lululemon. They still make 300 mil a quarter. Let's see if we can get an AI overview of their earnings. I would be curious to see if they have that. Okay, so America's revenue declined 2%. Comparable sales down 5%, impacted by weaker consumer spending and traffic. But look at this. Their international revenue surged 33%, led by 46% growth in China mainland and expansion into new markets like Italy and Turkey. The company opened 12 net new stores globally, totaling 796 stores, supporting international growth. So that international growth number is actually very impressive. Looks like the US is negative 2%, but the international is up like 30%. So yeah, 14 forward PE, that's usually appropriate for these kind of stocks. Yeah, here's their number of stores. Hey, dude, thank you very much, Dat One Dude. You just made my day. I hope you're having a great day, Dat One Dude. Thanks for that huge super chat. I really appreciate that, man. Actually, Dat One Dude, if you can say a stock really quickly, I'll check it out as my last stock on here. Because I'll do a quick portfolio update, and if I see a stock, then I'll go over it for you. But if not, don't worry about it. But anyway, that wraps up the stream. If you want to hit the follow button and the like button, I greatly appreciate that. I sell nothing, no course book. Let me show you my portfolio. I love being fully transparent. I'll show you my lifetime return, my total percent change on every stock. Here's my dividend-only portfolio, where every stock in here, has to pay a dividend. We're up 20% the past year, but here's my total percent change on every stock. Luckily, we are green on every holding in here, despite the past, couple of weeks have been a little rough. We also have our Roth IRA, we started this almost exactly a year ago. Let me click the all-time here. So yeah, for the first 2 months, it had $20 in here. But yeah, we started this exactly a year ago and we're down 6% all time. But my recent purchase is this company right here, Moog. This is an aerospace and defense stock. And my most recent YouTube video is an entire deep dive just on this stock. It's one of the most fascinating stocks I've ever found. Every single space mission in history uses their hardware. Like the Voyager spacecraft that's in space today collecting data still uses their valves and components. Every Formula F1 car uses 11 of their patents, valves, and components. It's just insane about Moog. They pay a dividend. They're an aerospace and defense play. They just got a $100 million new missile contract. They 33% of their market cap is their backlog. I'm just going over the highlights I know in my head. And no, dude, oh my gosh. Dude, thank you so much. Dude, Prentice and Cruz. Y'all did not have to do that. Thank you very much. Dude, they just gave a $20 super chat. Oh my gosh. Yo, Prentice or Cruz, if you have a stock you want me to look at, let me know. Oh my goodness, guys. I really appreciate y'all. Yeah, Prentice, if you have a last minute stock, let me know, man. I really appreciate you, dude. Thanks so much. He says, Verizon. I love that dividend on Verizon. Yeah, they really do have a safe 50% payout ratio. Dude, thank you so much. No, it's Canadian petrol station stock. Oh, I know what you're talking about. They own Circle K stock. Thanks again, Prentice. I don't even know what to say. And Dat One Dude and Cruz, thank you so much. He says, I'm looking into GLW and Amphenol. Yeah, Corning. This is actually a pretty cool company. I legit don't see this stock going under $100 ever again because of their other businesses. So Corning's, y'all got me all excited now. Dude, thank you so much for that gift there. So Corning benefits from NVIDIA's $4 billion optical investment amid infrastructure deal. But yeah, Corning owns Gorilla Glass. They make all the screens for Apple. The Apple phones, they have the Gorilla Glass. Corning launches Gorilla Glass Ceramic 3 for Motorola Razr Fold. Oh, they're doing that for other phones as well. But they fell 8.5% on Friday, which was really odd. It was because of the data center slowdown news, which it's so stupid. There's just one data center. Oracle's not expanding. It's already a huge data center. They're just not expanding it anymore. Yeah, dude, thanks again, Prentice. I just stay locked in. Dude, thanks, man. I really appreciate you, my friend. No, I don't really have to go. I'm just wow, dang, I've been live for 3 hours and I've been having so much fun. I really appreciate y'all. So Corning is at a 42 forward PE. It's certainly a great increase versus their 67 current PE. So the forward PE is much cheaper. But yeah, this is the Gorilla Glass. This is their display revenue. Gorilla Glass is 23% of all their revenue. But then their optical communications business, their basically optic fiber business, has really been picking up its slack the past 6 quarters in a row. It's up 30 to 50% every quarter. And they just signed a $4 billion deal with Meta. And it's not in this news right here, but literally Meta just gave them $4 billion. And that's why they gapped up on this day right here. They went from 130 to up to 162. But the forward PE is still a slightly bit expensive at a 42, but they've been expanding margins. Their gross margins up 4% after it grew 12%, net margins up 40% year over year. So look at this. The revenue's up 20, As we can see, like here's the pace of the revenue growth. The revenue's been pretty great the past 4 quarters, but look at the rate of their profits expanding. The past couple quarters specifically, the profits have exploded, up 71, up 95, up 208. So there's GLW. I actually have a potentially one that I like a little bit more, and one that I do own is actually Amphenol. Their top 2 customers, I believe, are NVIDIA and Google. So NVIDIA's NVLink spine uses Amphenol's copper cables and fiber optic solutions, and also Google's TPUs, huge customer here. So Amphenol is also very similar to Corning, but they don't do like Gorilla Glass and that other kind of business there. But check this out. The forward PE on this company is only a 29. Like they look expensive on the left at a 39, but this is why I think Amphenol is going way higher, and I'm buying them at this valuation. Like I literally bought it at this price like a month ago. It was at 129. I'm like, dude, a 28 PE, I'll pay that. It was back here too. I'm like $129 a share. It seems pretty attractive. Like if I didn't own this stock, like obviously I bought most of my position way down here at like $60, but like if I never owned this stock and I wanted them as 5% of my portfolio, I would not make it 5% of my portfolio today, but I'd maybe go ahead and make it like 1% of my portfolio because this valuation is really fair. And yeah, their communication solutions business, check out the growth here. It's up 77%. Like these year-over-year growth rates in the middle are so impressive, just like Corning. It's up 77 after 44. And that's just one business. They also have their harsh environment solutions. That is up 31 after 39. Like these are so impressive growth rates on all businesses. They also have their interconnect and sensors business. That is also at a record of 21%. And it's not just the revenue that's growing, it's also the margins. So check this out. The revenue grew 49. So the sales is up 49, but the net income is up by 60. And if we zoom out, this is a record net income. They've never even been close to having this sort of net income before, the past couple quarters specifically. And it's all data center growth, really. And they also pay a dividend. You get a 0.5% dividend yield. They actually just rose their dividend by like 60%. Check that out. The dividend went from 16 cents to 25 cents. That's a huge dividend increase. So 28 forward PE. Yeah, look at these expectations in the future. This is net income. And they've been beating on net income quite nicely. Like revenue's going to go up like crazy. EBIT's going to 2 billion. Net income's going to 1.3 billion, 1.35 billion in 2 quarters. That'll be a record net income. It's never been more than that before. So I'm just like really happy with Amphenol, and that's why they're called like the nervous system of AI, because like AI needs Amphenol's fiber optics and copper cable solutions. So it's just one of those AI like ecosystem beneficiaries. Like it's a tough right now, like owning NVIDIA, because NVIDIA's worth, what is it, like 4.4 trillion? Or yeah, NVIDIA's worth 4.3 trillion. It's a tough, like law of large numbers for you to double your money. They have to be worth 8.4 trillion. So that's why I'm a fan of actually looking in the NVIDIA beneficiaries list, like Comfort Systems and their cooling HVAC solutions, to Amphenol, who actually makes the copper cables and fiber optics for the NVLink and NVIDIA products and Google's TPU products. So in like Constellation Energy, to the nuclear reactors that are actually powering AI. You know, one of the biggest bottlenecks in AI right now is having enough power to actually, power these nuclear plants. So hey, thanks again, Cruz and Prentice. I hope you guys have a fantastic rest of your weekend. I'm gonna definitely be live tomorrow. We're gonna do 2 live streams tomorrow. I think I'm gonna do 2 3-hour live streams tomorrow because we always do those on Sunday. So yeah, thanks again. See you all later. This is like the best stream I've ever done. Thanks so much, y'all. I can't believe. Thanks again, Cruz, and everyone on the YouTube stream. Nicolo, Prentice, that one dude, Cruz, Stone, Good Luck, Norbero, all the members. Thanks for becoming a YouTube member too. Thanks so much. Actually, yeah, thanks again, Nini. Hey, thanks so much. See y'all soon. Dang, 3 hours and 15 minutes. That is my longest stream ever. I've never streamed for over 3 hours and 15 minutes before. So thanks again, y'all.